Afternoon and good evening, real estate investors. I want to say thank you for joining me here at Note Investing 101. It's our what we call our Note Weekend training class. It's a 2-hour class. I promise to probably get you out of here just under that on how to get started and how to learn the basics of investing in banknotes. Now, note investing is a broad niche. Some people consider note investing when they hear about, hey, you're going to sell a house on owner financing, you're going to sell or buy on terms, and that's one facet of creating paper. We've done a lot. We do a lot of that. But my favorite niche is actually buying mortgage notes, bank notes directly from lenders, hedge funds, and buying it at a huge discount. And I usually primarily buy non-performing notes, and that's why we get a bigger discount, bigger yield, and a lot less headaches than traditional real estate investing. So I encourage you to check back as this is the 2026 edition of this class. It's hard to believe we've been teaching this class now for over 6 years on teaching the basics of note investing and what we focus on and what we focused on for almost the last 20 years. But anyway, we are here to help you learn the basics, dip your toes in the water, see if buying banknotes is something that you might enjoy doing, whether you're a seasoned real estate investor or brand new to real estate. Guess what? Everybody can buy notes these days. All right. But first and foremost, I'll tell you a little bit about me. I'm Scott Carson. I'll tell you why you should be listening to me for the next hour and a half and then following up with more stuff. Is that I've been an active real estate investor since 2001, bought, flipped, foreclosed, been a landlord, raised capital, but since really for the last 20 years, I've been focused solely on buying mortgage notes from the banks. Okay, and I'll show you how to do that. I'm an award-winning educator and podcaster. I've spoken all across the country, spoken internationally on buying and investing in distressed debt. I'm also my podcaster. It's amazing to see how far we've come for over the last almost 9 years now as a podcaster with the Note Closure Show, Note Night in America, and a few other things that we do. I'm most proud of the fact that I've helped thousands of investors like you get started buying their first note, their first 30 notes, their first 20 notes, their first 100 notes, and taking it to a whole new level where they enjoy being the Lien Lord versus the landlord. And I can also help you invest in Main Street like Wall Street does. Wall Street does not buy properties to fix and flip. All right. They don't do that. Wall Street buys the debt. They want to own the debt, the cash flow, and learn how to leverage that without having to do all the work, all the maintenance. Yes. Will some banks take stuff back and fix it up and sell it? Yeah. But they don't like that. And you should learn something from the banks because over the last 20 years, since 2007, 2008, we've had this huge opportunity of buying non-performing notes from banks and hedges. Yes, you could buy them beforehand, but they become much more accessible to you guys now on a one-off basis. You don't need millions and millions of dollars to buy notes. We've got students that are buying their first note with 10 grand, 20 grand, 50 grand, and making an above average return in their IRA or raising millions of dollars in private capital from other investors out there to go fund deals and making it a win-win solution for you. So let's dive into a little bit of that. But once again, guys, WeCloseNotes.com is my main website. Our website with our note buying for dummies workshop is the #1 investor recommended training for note investing. So highly encourage you to check it out at notebuyingfordummies.com. But we'll get that later on. Let's dive into the content today so you can get rock and roll. I always encourage you, if you're going to have questions after this class, I know it's going to happen. You can always book a phone call with me directly at talkwithscottcarson.com. That's talkwithscottcarson.com. It's a 30-minute call, or we can do it via Zoom if you got a deal you're working on or you've got a question. You're going to have questions. I get it. That's why I make myself available to talk with you. And I guarantee rarely will you get anybody else to talk with you to give you the true insights and not blow smoke up your tail and tell you exactly how this business is, like I will at talkwithscottcarson.com. So there's no cost to that. Book a phone call and let's dive into it and get rocking and rolling for you. But anyway, all right. So let's dive into this first session. There are a variety of other resources you need to know about that you can tap into. These are free resources, okay? Obviously, we have a Facebook group. It's a kind of a semi-private group called Note Nation Facebook group. It's got about 1,000 plus members on it. We have the Note Closure Show podcast. You can listen to that anywhere you listen to podcasts or at WeCloseNotes.com. We have our weekly webinar we do on Monday nights called Note Night in America. We've been doing some sort of webinar on Monday nights for over 14 years now. And you can go there. It's free to register. Really what our focus here is, it being 2026, is diving into assets and breaking down assets that you can purchase, you can cherry pick from, you can buy for your own portfolio, or deals that you could potentially fund on deals that we're working on. So NoteNightInAmerica.com. We also have the Note Night in America podcast for you. Of course, the #1 YouTube channel, WeCloseNotes.tv. And of course, the link I just told you guys to book a phone call with. But there's also my AI clone. If you want to ask my clone some questions after hours or the middle of the night when I'm not available, you can do so there. And then, of course, our next steps, usually following this, is people will sign up for our 2-day workshop at notebuyingfordummies.com, or they'll sign up for a monthly membership at $97 a month at noteumbrella.com. And then, of course, for those that really want to take it to the next level, we probably should talk about our one-on-one coaching and mentoring program that's so successful out there. It's the best out there when it comes to helping note investors buy deals. But anyway, like I said, there's the logo for our main podcast. And like I said, if you go to YouTube, look for WeCloseNotes.tv, and you'll be tapped into thousands of videos, thousands of case studies, so much great information there for you. That's why we have the #1 YouTube and the #1 podcast when it comes to note investing. But the big question I want to ask you guys and gals that are here is, what do you want to accomplish with this? What are you looking to accomplish overall as a real estate investor? Are you going to do this just for 6 months? Or are you going to do this looking to add this to your portfolio for life? Well, the answer to that is always B. I don't think true real estate investors never retire. We just kind of slow down a little bit, right? We never quit what we're doing. We're always going to be investors. So many people come to real estate investing for a variety of reasons. Why are you here? What is your why? Are you looking for cash flow because you're not making enough at your job, or maybe you want to stop dealing with toilet sinks and trash outs? You want to find an alternative way to make cash flow? Are you looking for deals? You can't find assets in your backyard anymore or in your local community. You're looking for an alternative source to find deal flow for you. Notes are a great way for that. Are you looking to boost your income in retirement? Maybe you're not making enough. Maybe you got some IRA money you've had from a previous job or a previous role where you're wanting to put it to work to make an above average return. We can do that on a passive or part-time basis. Are you just tired of being tired? All right. I know a lot of folks are just tired of being tired, especially in this economy and with what's going on with real estate being so expensive and cost of goods being higher, gas tweaking up a little bit. It's still very affordable here in Texas where I'm at. And here's the thing, I don't care who you vote for, whether you're a Republican or Democrat or independent, you just have to deal with things. All right. Life is what it is. If you're worried about what's going on in Washington more than what you're worried about your own budget, your own pocket, guess what? You're wasting time. You are part of that problem. But if you want a solution, then it's better to start focusing on your own problems and how we can solve that in today's world than focus on what's going on in the media. And guess what? With notes, you can solve a lot of these issues, ladies and gentlemen. All right. And if you've got money sitting on the sideline, you want to make an above average return, let's talk about how to put your money to work to make an above average return, 8, 10, 12%, depending on the deal for you. Whatever your why is, we can help. So whether you're wanting to be active or passive, let's talk. Let's show you the way to do it and why notes, I think, is the best way, the #1 investment vehicle for your hard-earned money. Okay, so let's talk first about the second. Sorry, not the second, but the types of notes that are available out there for you. And it always kind of breaks down into two sides of the note business. You have institutional and non-institutional debt. Now, many people, like I mentioned before, are more familiar with the non-institutional side of debt. Oh, we're going to talk about owner financing a property and carrying paper, or I'm going to buy on terms. And that's a great way. But what we focus primarily is on the institutional side for a couple of reasons. And we'll get to those reasons a little bit later on. But first and foremost, there's a variety of different product niches that come across our desk on a regular basis. And it breaks down first and foremost the institutional, which means it's originated by a bank or a lender, or non-institutional. It's originated by a private investor or an LLC of some sort, okay? You have residential first liens that are performing. Yes, you can buy performing paper. All right. There's also residential first liens that are non-performing. This is one of our favorite aspects of the business, is buying non-performing notes at big discounts. You have residential second liens or junior liens that are both performing or non-performing. We don't see a lot of these like we used to. All right. I've had people reject, oh, I want to buy a portfolio of second liens at like 50 grand. Not going to happen. All right. There's not been as many second liens originated as there are first. Plus, the price point of them is so much higher. It just doesn't make any sense to buy in a second lien position for me. I'm sorry. Yes, if you're using your own funds and you want to put a little bit to work because you only have a little bit of money, that's fine. It might work out to buy one or two, but I would rather make a bigger check, all right, in the first lien space. Plus, it's also easier to raise capital in the first lien versus second lien position, okay? You also have commercial first liens that are performing and commercial first liens that are non-performing. And commercial runs a broad gamut of like mixed use, industrial, warehouse, um, apartments, office, medical, self-storage, RV parks, all that good stuff. We are not going to get into the different types of commercial notes and how to break that down. When I talk about note investing, if you want to learn the commercial side about commercials, you really need to be an expert in that specific niche because underwriting and evaluating a note is so different when looking at commercial assets versus residential assets. Don't get me wrong, we've bought both. But when you're starting off, let's focus on the residential side. Of course, you can buy owner finance notes that are performing and non-performing in today's market. You'll see stuff. I don't go out and buy leads of owner finance notes. I've seen way too many people buy those leads. I mean, I've bought those in the past and then spent thousands of dollars on marketing to get nothing. I don't like targeting owner finance notes. Now, I'll talk a little about it. I'll advertise that we buy them. But I want people coming to me versus going out and chasing one borrower or one lender who's got one note and is kicking the tires. I would much rather deal with banks who have a variety of product on a regular basis that they will send to you on a scheduled time, once a week, once a month, once a quarter, that I don't have to do any marketing for to find deals. Besides jumping on LinkedIn or an email blast, it's much easier and evergreen when it comes to finding notes. So yes, you'll see some owner finance notes that you can buy and sell on performing and non-performing. Contract for deeds are another product. This is a non-institutional product because it's basically owner finance from a lender or a property owner selling a property on a contract for deed or land contract. It's not the same. It's not treated the same as a mortgage in a lot of states. Sometimes it's treated as a tenant relationship versus a borrower. So it can lead to faster foreclosures or evictions, depending on the state. All right, so keep that in mind when you're looking at stuff. And then, of course, we do see some lease options from time to time for people trying to sell those as a note product. It's not necessarily a true note product unless it's converted to an actual contract, but you'll still see those from time to time. Now, where should you focus? Now, that's all about what you want to. A lot of people come into this and they look at either cash flow or property. Well, I'm a big believer that you need to focus on the cash flow side of the business because that's what note business is all about. Repeat cash flow. If you're using notes to find property, don't get me wrong, you can still do that. But if you're looking in, like, I live in Austin, Texas. If I was just looking for stuff in Austin, Texas, I would have gone broke a long time ago. You have to have a broader view. So cash flow is king. You can't fund your deals or buy stuff, pay for groceries on appreciation or equity. You buy it on the cash flow side of money coming in. Return on investment is important. What's going to be the biggest return on your investment? And then there's also return on time. What's going to take the most amount of time or least amount of time, depending on what type of time you have in your schedule. Do you want another 30 hours a week? Yeah, we can do a lot. Most investors get started about 5 to 10 hours a week. Of course, inventory is important, or what you want to focus on. Some states have more notes available than others. And there's also asset classes, like I talked about. Oh, I want to focus on condos, or I want to focus on multifamily. Well, you got to understand what's available in today's market. Of course, pricing. Stuff in Miami of Ohio is much more cheaper and more affordable than Miami, Florida. Austin, Minnesota might be cheaper than Austin, Texas. So understanding the pricing point, of course, you're going to pay more for performing out. If it's in a fast foreclosure state like Texas or Georgia, you can pay a little bit more than you say would in something that's in Florida, South Carolina, New York, New Jersey, which takes longer to foreclose. And like I said, time. How many hours per week are you wanting to put into it? 5, 10 hours per week? Many people get started. We don't want to create another job for you. That's not fun. We want to help you work smarter, not harder. Okay? And like I say, when it comes to goals, one of the greatest things that we have put together is really a game plan for you to help you work to getting to 6 figures in the next 12 or 24 months. All right, our 2-day workshop, our Note Buying for Dummies workshop, that's one of the big presentations we go through there, showing you how to build a plan to make 6 figures in 12 to 24 months on 20 to 40 deals. And yes, everybody could do that. And that's the biggest thing I want you to think about. But also, if you don't have capital, that's okay. If you don't have your own money or you only have a limited amount of money in your IRA or 401k or savings, that's okay. But we will show you the way and how to raise $1 million in capital in the next 3 to 6 months. And we'll talk a little bit about how we target that later on here in this training. Okay. First thing you got to know, every state's a little bit different, especially when you're buying non-performing. You're going to deal with foreclosure timeframes. It's going to be different. Judicial foreclosures. Some states are judicial, which means it has to go through the judge. All right. It's a longer time frames and there's a longer process, usually 6 months or longer. All right. Like New York is going to be take like 3 years. All right. The costs we usually going to start at $3,500 or $5,000 to foreclose and above that. Most of your judicial states are east of the Mississippi. I'm going to put an asterisk because like California does have a judicial foreclosures for an owner occupied thing. Usually you're going to pay a little bit of a cheaper price than buying something in a non-judicial state just because you've got to hold on to it for longer. And that's your foreclosure costs are going to increase. And that means your holding costs are going to increase. Okay. Non-judicial foreclosures where most people they want to dive into that. I'm just going to buy non-judicial foreclosures because it's a fast foreclosure state. Okay, that's fine, but you're going to actually pay more because they do have a faster foreclosure time. Like here in Texas, it's 21 days. Once you're 90 days late and you file something, the notice of default 21 days prior to the first Tuesday of the next month, you can foreclose. Other states can take up to 120 days. It's less expensive. Usually foreclosure is about 1,000 is the cheapest we found it in here in Texas. Most of it's going to be west of the Mississippi. And though and you're going to pay a little bit of higher price point because it is such a fast foreclosure process. Something in Texas is going to cost more than say in Florida because of that fast time frame. Okay. I like to tell folks start off with 3 to 5 states and pick a couple states with bigger cities in both kind of pockets. Okay. I like Ohio as a judicial foreclosure state, but I also like it because I buy stuff that's occupied that I know I can get worked back out for cash flow faster than the 9 month to foreclose. Okay. So keep that in mind. You probably want to start off 1 or 2 states in each kind of foreclosure process, judicial and non-judicial, just because you're going to need to know that for more deal flow for you. Okay. Now, the question people always ask me, do I need a license to do that? What kind of requirements do I have? And the answer to that is yes and no. Okay. Depends on what state you're going to buy in. Well, the great thing that I love about the note investing business is the fact is that you have servicing companies that do a huge amount of the heavy lifting for you. Think of them as your third party, you know, oh, manager, property manager. Instead of them going out and collecting rent, they're collecting the monthly payment. They're reaching out to borrowers if they stop paying. They're going to handle the paperwork. They're going to hand out the statements. They're going to collect it and adjust the balances. They're going to check your taxes. They're going to check your insurance on that stuff. Okay. So in most states, if your servicer is licensed as a debt collector in a state, it's going to solve things. But some states do require a separate debt collector's license and other fees, like Illinois wants you to be a licensed debt collector separately from your servicing company. All right. Some states like Ohio, they want you to get a separate debt collection license for second liens. Oregon, Washington, Maryland, Massachusetts all require you to have a separate mortgage banker's license or mortgage broker's license to do that stuff. And then Georgia has a required license to get you become a mortgage broker's license in that state of Georgia. Now, the exclusion of that is if you're buying in your own name or you're using your self-directed IRA. That's the exception, but I would not recommend buying in your own name, buying a note. But there are some third parties out there that allow you to partner with them, and we've got some friends that will do that if you're going to be buying in Georgia. Okay. Now, some states do require you to be a licensed mortgage broker, like I talked about California. If you're buying notes in California, they want you to be a licensed mortgage broker there in California. Okay. Like I say, talk to your servicing company. And if you don't know who a servicing company is, we highly encourage you to talk with like Covey Financial out of San Antonio. They're a company that we recommend. But if you're already using a different company for your performing notes or owner finance notes, talk with a servicing company and find out which states they are licensed in and what requirements to make sure that you're not violating anything. Last thing you want to do is buy a note that you can't end up collecting on because the Attorney General shuts you down. All right. Now, what is available in today's market? It's 2026. It's not 2008 anymore. The market has changed, right? So, like I said, you can buy reperforming notes. This is what a note that was once non-performing. Somebody like me bought it non-performing, got it back to work, and I'm looking to sell it off and still give somebody a 8 to 12% return on a reperforming note because I bought it at 50. I'll sell it at 80. Non-performing notes are still available. We see, people talk about, oh, this is a low default rate. Yeah, there's a low default rate on new stuff, but there's still plenty of stuff out there from previously that's still non-performing that you can buy. And with defaults increasing and inching their way up back beyond what they were over COVID, we're seeing increased default rates means more opportunity. Contract for deeds you can buy. These are smaller valued assets in a variety of different states. Non-performing commercial notes, we talked about that. You've all seen the news with commercial defaults, foreclosure, stuff like that increasing. You can buy commercial notes that are in default. Um, don't expect to go buy a 200, 300 apartment complex when the borrower's not paying, it's going to foreclosure. Most of the banks are foreclosing on those and taking those back if they can. Okay, they're not looking to sell those at a huge discount. We talk about old notes on platforms like PaperStack and a few others. Yeah, you'll see some stuff that's been floating around for a while. You can buy that. It's a great way to get started, but I don't encourage it as a long-term viable option to be a note investor beyond one or two notes at a time. Okay. And you can also buy newly originated owner finance notes. If you want to chase that, go right ahead. I'm not going to waste my time doing that. We get people that call me all the time. Oh, hey, would you buy this note? It's got 1 month of payment. I'm like, no, I want 12 months of seasoning. I'll buy it, but I'm going to ask for a big discount. I'm not going to pay par or full value for a newly originated note. It just does not happen. Okay. And one thing, as a note investor, this is one of the hardest things that a lot of people struggle with is the banker's mindset versus a fix and flip mindset. I struggled with this my first 2 years coming in the note business. When I would buy, everything I bought was non-performing and I was foreclosed on everything because that's where I came from, right? Oh, deadbeat borrower, just needed to foreclose on. Well, I should have had more of a banker's mindset because I realized looking back in hindsight's always 2020, as they say, that if I look back and was willing to work it out with the homeowners on those notes, a lot of them I would have made more cash flow. And that's the thing you got to realize. When you're buying a note, you're not buying the property. You are buying the note. You're the lender. Okay. A lot of people get into this. Oh, look at all this equity. Well, you're not. Equity doesn't exist to you as a note holder. You're only entitled to the legal balance, the payoff amount of the loan. Now, of course, if it takes the foreclosure and nobody bids at the auction, guess what? Then you own the whole property. You can offer cash for keys to borrowers to avoid it going to foreclosure. We've done that before in some cases, but you have to understand if you're evaluating a property, it's all about as is. There is no after repair value in the note business, okay? And that's why we always say you want to streamline your products is what you focus on. I like to buy non-performing notes where they owe more on the property than what it's worth, because then I kind of control my equity by buying it at a discount, right? Or I'm going to target owner occupied assets where there's less than 20% equity, the borrowers won't fight you for that. Okay. You want to avoid the shiny objects and, as I say, the squirrel syndrome by chasing all these different things. The more narrowed your buy box can be, the happier you'll be, the more awesome that your profit margins will be. Okay. Cash flow should be your number one priority. If I'm buying this note and it's occupied, what kind of yield can I get keeping the borrower back in that property? Now, of course, is every borrower going to reperform? No. We still foreclose about 20, 30% of the time on stuff. Of course, if the borrower's already left the house, moved on, or passed away, you know you're going to foreclose. But when it comes to cash flow, you're all about building notes, and that should be your number one priority. Taking back real estate and doing fix and flips are going to be your secondary market. And then, of course, if you take a property back, if you want to owner finance it or keep it as rental, that's your choice. I'm a big believer in selling that asset off, bringing my money back in, and then go out and rinse and repeat and doing other things. Okay. So let's dive into session 3 here on the different types of note sellers available in today's market. Well, there's a ton of places to find note sellers. Most people won't do this, but if you learn how to market like we teach, you will find plenty of deal flow. Plenty of deal flow in today's market. All right, you can go to banks, which is one of our favorites. You can go to lending institutions, mortgage bankers, servicing companies, note conferences and conventions. LinkedIn is where we spend a lot of our time. All right, private sellers, county clerks to track assignment claims of when a note is sold. You can track to who's bought it and who sold it. You can also go to foreclosure lists and target either the bank, which is the lender, or the attorney and try to buy the note through them. And we do a very big deep dive. It's our whole first part of our class on Note Buying for Dummies is how to find deals. And to give you a bit of an idea, there are 5,000 federally chartered banks out there, and there's just under 20,000 lending institutions originating loans, mortgage bankers, mortgage companies, a whole bunch, okay? There's also hundreds and hundreds of servicing companies servicing loans for investors like you and me. Those 4 places right there is plenty of inventory if you will learn how to market. Unfortunately, most people are going into these Facebook groups, which are just private sellers and one-off sellers. Just does not make sense. You have to understand marketing is important. Going to note conferences and conventions is great, but there's often not a lot of sellers there. There's a lot of note investors there talking about it, And that's why I don't really go to any note conferences anymore because there's no reason to go. I know most people there. Everybody's looking for deals. Well, instead of you going there and looking from people who are looking for deals, why don't you actually go to the source directly? And that's what we've really hung our hat on and showing you how to really get deals direct from banks and hedge funds. Okay. Um, if you're going to target banks, there are a few different department names you want to focus on. One is a special assets department. That's going to be your largest institutions. No, you're not going to buy from Chase, Citi, Wells Fargo, Bank of America. But there's other larger banks out there that they call their department the special assets manager, the special assets department who handles note sales. There's also secondary marketing departments. You'll see this for banks, REITs, real estate investment trusts, stuff like that, lending institutions who have bought portfolios. That's a great job title to look at on LinkedIn. Whole loan sales departments. You'll see this REITs and larger insurance companies or funds will have whole loan sales department where they're moving whole portfolios off or letting you cherry pick. Smaller banks, smaller region banks will call their department the chief credit risk officer. They may even be the loan officer that originated the note if it's a small one-off bank in rural America. Not saying you can buy anything at a big discount there because they're too conservative. They can't take a big 20, 30% loss on the loan, but there's still opportunities. From time to time, we'll get stuff from D, but we really primarily focus on A, B, C, or D. All right, for you. There are some websites that help you find notes. You can go to laneguide.com, which has been for over 50 years in targeting what banks are sold to what banks. They often publicize different internal numbers and emails of asset managers. It's like $165 a year. We've used that for years. Bauer Financial tracks FDIC banks and then also credit unions who submit their quarterly reports to get their FDIC insurance. We will often once a quarter buy a list of them of banks that have more than 5 branches, and it gives us their whole financial breakdown, how far upside down they are, what percentage of the portfolios in default, what's coming down the pipeline the next quarter is 30 to 89 days late, residential, commercial stats, multifamily stats. It's really a great resource. That's about $300 to $400 a quarter, right? FDIC.gov is free. You can go there to see which banks are in trouble, what banks have gone out of business. The Texas Savings and Mortgage Lending here in Texas, we leverage the licensing department in Texas and a few other states to download the list of licensed mortgage bankers, licensed servicing companies doing business here in the state of Texas. And it gives us a contact list to reach out to those companies individually. And then, of course, like I said, loan servicing companies, you can go to the National Mortgage Loan Originator, NMLS.gov, and do a search on there by just typing in servicing. It'll pull up hundreds of servicing companies. Some of these servicing companies have a trade desk or have somebody that's handling the trading of notes on behalf of their clients. Okay. And then, of course, other state license websites. Some will vary. Some are easy to get a hold of. Some are. Don't ask me specific questions about your individual state. Just go check it out yourself. Go look for the Florida mortgage lending or mortgage lending licensing department, something like that. Now, what do you say? What don't you say when you're contacting these banks or lenders online? Well, the biggest thing is it's important knowing what not to say more so than what to say. Okay. The idea is if you're going to reach out to your bank asset managers, you're going to have a basic elevator script. And we've actually provided this pitch in our workshops. And it comes down to asking the major question. Hey, are you the right person? And what do you have on your books that you're looking to move? Okay. I'm looking to buy for my own portfolio. I'm looking for something with some hair on it, especially if you like the non-performing side. We're looking to work it out with the homeowners if they ask what you're going to do with it. Always say that, even if you're planning on foreclosing. They like to hear that. Indeed, we're looking for non-performing notes in these markets or states. Now, I don't get specific to one city or one market. Okay. I say we're buying in most of the major markets across the country. We buy in about 20 to 30 states. My whole goal is to get the lender or the special asset manager of the bank to send me the list of what they have all across the country or across the state. So the more specific, like I only buy in Austin, Texas, that's a big okay. You don't want to do that. All right. You want to say we're buying in multiple markets. I'd love to see what you have about. Now you're also not going to go say, oh, we buy anything. No, you don't buy anything. Okay. That tells me you don't buy. I mean, when you say you buy everything, it tells me you don't buy anything. Okay. We buy, assets that are 100 to a million in value that are non-performing in most of the major markets across the country. That's kind of a normal common thing. Okay. Let's see what we got. Now, do not say these items. Don't come and say, hey, I have 20 million a month to buy. They're not going to believe you. That screams out joker broker. I'm looking for notes and REOs. Nope. If you're contacting a bank and that's what you say, I'm looking for notes and REOs, they're just going to forward you to the REO department, which is just a voicemail box that tells you to call the listing agent on the website. Okay. I'm looking to broker or wholesale. I don't care if you are looking to broker or wholesale. Don't tell the bank that. Okay, they don't need brokers. They don't need wholesalers. All right. Don't say that. They don't waste your time. Okay. Don't say I represent a buyer or I'm a buyer's rep or a buyer's mandate or a seller's rep. That just sounds like a big joker broker, and I want to vomit in my mouth anytime I hear that from somebody. Okay. And like I said, I'm looking for anything. No, just be specific. Hey, I'm looking for first liens that are non-performing, with values 100 grand plus, and go from there. That's a really great thing to say. But the rest of the stuff, I'm looking for this one zip code in Austin, Texas. No, don't do that. Don't waste your time. Go do something else. Okay. You want to make it easy for them to hit the download button to send you the spreadsheet or the tape, as we call it. Okay. Now, if you're gonna build a list of emails and you find contact information off licensing websites or off of their LinkedIn profile, emailing is the easiest thing for you guys to do, and you can create a list and upload it to a CRM and drip mark it out to them once a month, which is one of the great things you do. You want to make sure that your email goes out on a Tuesday, Wednesday, or Thursday. All right, not Monday or Friday, between 10 a.m. and 3 p.m. their time zone. Okay. Well, Scott, I worked, Tuesday, Wednesday, Thursday between 9 a.m. and 5 p.m. How am I going to email it? You're going to use a CRM tool like REI Blackbook or, God forbid, MailChimp or something like that. Easy, okay? The first email you send out, you're going to see a 10 to 20% open rate. After that, the second time, yes, send the same email a second time to those that didn't open the first time around. That's a 5 to 8% open rate. And you don't want to even send it a third time later, about 24 hours later, at 1 to 4% open rate on that third email. So I send it on a Tuesday, second one goes out on a Thursday. Third email goes out on a Tuesday. Okay. Um, you want to give it yourself at least 48 hours or 2 business days apart at the opposite times of the day. So if you send it at 11 a.m. in the morning, on the first one, send the second one in the afternoon. All right. And that's the whole goal, is rinse and repeating. I've been doing this rinse and repeat thing for a decade, ladies and gentlemen. I have asset managers that send me stuff on a regular basis that get my emails and call them the green email, right? They reach out to me, hey, I don't have anything this month. But when they do have something, guess what? They think about me. And you guys can replicate this. It's not hard to do. All right. Very simple, no longer than an email. It's 20 lines of text and directly to the point of what you're looking for. Okay. Now, if you want to take that next step and really do reach out to asset managers, it's easier to do these days than it used to be 10, 15 years ago. All right. The best time to call asset managers are Tuesday, Wednesday, Thursday. Same time, 10 and noon and 2 and 5 their own time. Understanding what time zone they're in is important. Who you calling, when you're calling. You're not going to call the customer service number. You're not going to call loss mitigation, because they're just not going to know. You're going to have to call the main corporate office. We use Lane Guide to find the main corporate office numbers on most of these institutions. Okay. And expect to leave a lot of messages in voicemail boxes. Always, always leave a message. Hey, this is Scott Carson. I'm calling. I think you're the right person, James Smith, who handles your note sales. I'd love to talk to you about it. Expect to leave a lot of messages. If it's, a lot of these bankers will have their phones forward to their cell phone if they're out. If you get a cell phone number or something like that, hey, shoot a text message. It's not going to hurt anything. Pay attention. Speak clearly, slowly. Have your elevator speech and repeat. And like I said, leave your phone number twice. Okay. You're going to leave a lot of message. If you make 50 phone calls, very important, smile while you dial. If you're in a bad mood, don't make phone calls. But if you if you make 50 phone calls, you'll probably talk to about 14 to 16 people. You'll probably sign 4 NDAs off of that, and you'll probably get a deal or a tape with either one deal or 1,000 notes. Who knows what's on that list? But one source who sends you stuff on one day is very valuable. When I first started this, I wanted to challenge myself years ago to having signed 100 NDAs. Well, at the end of the first month, I was like, I need to expand that to having 1,000 NDAs at the end of the first year. And we achieved that. Okay. Now, like I said, you have to learn to follow up. This is where most people drop the ball. Follow up and follow up and follow up. Asset managers are not going to get mad that you follow up. If they tell you, hey, I'll have a list next month, and you call them next month and you leave a message and they didn't send you anything, guess what? Follow up. Make a phone call again. Drop them another email. Send an email. Make a phone call. Jump on LinkedIn and track them down on LinkedIn. Hey, just wanted to reach out to you. You can use things like Rocket Reach or Sales Navigator or even AI to find the right email and phone number for a lot of these asset managers. And the whole idea is just to repeat, repeat, repeat. The thing you have to realize is most of you out there come from the real estate space where you're sending out letters and postcards as stressed assets and foreclosure lists each month. What if you never had to do that again? What if you just dropped an email blast out to people and they sent you their list on a regular basis? This is what we do, ladies and gentlemen. We don't rely on people to send us just one thing or one source. We deal with multiple sources. A lot of note investors back in 2008, 9, and 10, they got used to buying from two or three sources, and that was it. But when those sources went out of business or pivoted to something else, they didn't have any note deals. And this is one of the things that we always talk about. It's the follow-up. It's so important. You always got to be creating new lead generation because people will come in this business. Funds will create and come in this business. We also follow up on deals that we make offers on 30 days out because we close on a lot of deals where our initial bid was not accepted. Okay. You have to realize that 80% of sales are made after the fifth contact. So keep that in mind. Five contacts. I've got to send at least five contacts to get the ball rock and rolling to be in the game. That's what it comes down to. All right. If you don't understand that with email marketing or social media marketing as well, go do something else. Save you a lot of grief because you're just going to get upset. I sent one email, I made 12 phone calls, and nobody said anything. Well, guess what? You barely touched the tip. Okay. Make separate lists of who you actually talk to when you're making these follow-up phone calls or the original phone calls, and that becomes your hot list. I start off with 50 banks a day. If I got through 35 of them and left messages, then the first part of the second day was making the 15 phone calls to those I didn't get to. And then 2 days later, I would hit those 35. Hey, just wanted to follow back up, or the week later. Okay. Now, we spend a huge amount of time in our virtual note investing workshop. We call it No Buying for Dummies. It's a 2-day course that we teach about once a quarter, live with me via Zoom. It's an all-day thing on Saturday and Sunday for you to dive into. It's really the number one class that our students have taken to learn, where we show you how to find, fund, flip, and flow. All right, very affordable for you, and definitely should be something you get signed up for. Now, of course, if hey, the 297 is a little steep for you, or you want to try something a little cheaper, you can always go to our monthly membership. It's at $97 a month. Includes access to our virtual workshop and some other trainings for you. It's designed to help you spread your training costs out over the year and stay up to date with things. So it's just $97 a month, and you can get signed up for that at noteumbrella.com. All right. Now, let's dive into the different markets and pricing points of notes. Okay. Now, let's talk about market expectations because markets are always constantly changing. Some states are getting easier to buy in, others are getting more difficult. Okay. They completely vary based on a variety of things. Either the popularity of a market, like I said before, Miami, Florida is a lot more excitable than buying something in Miami, Ohio. Market values, obviously. Things in Los Angeles will be a little bit more valuable than, say, something out in Dayton, Ohio. The foreclosure timeframes will vary. Texas, everybody loves Texas because it's the fastest state to foreclose in versus like New York, which can take 3 years. And then, of course, you want to look at where the population is. You know, a lot of people will look at small balance notes like, oh, I'll buy something in a small market. Well, I always recommend staying in cities that have at least 50,000 people or greater. The reason when you start getting into the small markets like 3,000, 5,000, you have less realtors, less buyers, less vendors to help you out with that stuff. Now, I'll buy in a small market if I have carnal knowledge. Like I'll buy in South Texas, down in Ingleside or Aransas Pass or Port Aransas, which is by Corpus Christi. It's only about 30 minutes outside of Corpus, but I grew up in that neck of the woods. I have resources and I know the market like the back of my hand. Okay. And like I said, more about the location, avoid rural assets. When you start looking at assets and it's out in the middle of nowhere, avoid it. Unless you know that market or you're targeting like raw land or stuff in an area like that, just avoid it till you get your feet rocking and rolling. All right. Till you get your business rocking and rolling because you don't want to buy a note and it drag out. We had some students who thought they were smart. They were going to buy this portfolio of these low balance, low valued REOs that were all rural with the idea they're going to owner finance them. Well, guess what happened? Even though they were offering great terms in the owner finance note, nobody wanted it. Okay. You got stick to the pool. I'm not here to try to lead you astray, but when I've done this for 20 years, I don't want you to make mistakes that are going to cost you. All right. And that's the biggest thing. Let's avoid making mistakes and making profits. Okay. Been there, done that, got the scars and the t-shirt. You don't have to go through the same thing that I have. All right. And of course, inventory. You may want one specific market, but there's not any inventory. You got to change your market up. Like I said beforehand, I live in Austin, Texas. And yes, we are seeing more increased stuff here in Central Texas, but when I first started, there wasn't hardly anything here. So I had to look outside of my market, outside of Austin, outside of Texas, and that's why we've bought thousands of deals outside of the Lone Star State. No, I didn't have to jump on a plane to go look at it. We use vendors, and we'll get that later on to do that. But that's the great thing about market expect. Now, what's hot in today's market? Today's being 2026. The most expensive note markets haven't really changed much. That's California, way overpriced. Well, although we are seeing a few more notes in California than beforehand. Arizona, a lot of distress there because a lot of investors bought in Arizona, and Phoenix and that neck woods, it's taken a big hit. Texas is always hot here. We are seeing more distress in Texas, Dallas, San Antonio, the Valley, and Waco and stuff like that. So it's more opportunities. But people love buying in the Lone Star State. It's the friendliest state to lend and foreclose in. Nevada, Sin City, Reno, we are seeing more distress there. People like those areas. Sin City, who doesn't like Sin City? And then, of course, you have like Georgia. People love Georgia because it's a fast foreclosure state, second to Texas. But you just got to be careful about buying in Georgia. If you're going to buy outside of your own name, use an SDRA. If you're not going to use that and you want to use an LLC, you really need to partner up with somebody so you don't get tagged by the Attorney General. You don't want cease and desist and fines, right? And of course, people want to buy on the West Coast. I would say the popularity for Oregon and Washington State has dropped off because of the licensing requirements and how unfriendly they are to landlords. The communist side of those two states just doesn't make it friendly for real estate investors. By West Coast, you could also throw in like Colorado, Utah, Idaho. Those are very popular states as well too. Some of the bigger markets there with the growth going on, but they're going to be the most expensive as well. All right. Now, what's not so hot? The least favorite markets really hasn't changed this month. New York. Don't buy in New York unless you live in New York. And a lot of people call, I want to buy in New York. No, you really don't. Okay. Same thing for New Jersey. New Jersey can take you 2 years to foreclose. The one exception in New Jersey is that it's got a vacant property, which is 6-month expedited foreclosure. So if the property's vacant, you can get away with it faster, but you got to really want to buy there in New Jersey. Kentucky, don't see a lot in Kentucky. They do require a separate bond for business and personal, depending on how you're buying it. I don't buy in Chicago. Cook County, if you live in Chicago, that's an exception, but if you're an out-of-state investor, don't buy in Cook County. It's just not a very pleasant way to do things. And then also too, what's not is you're trying to buy assets under 30,000. That's hard. I mean, I've bought plenty of those deals over the years, and you can make some good money, but also understand where it's at. All right, a roof, an AC can kill your deal if you've got to replace that or do something that's not friendly. Stick to the 50,000 and above assets, and you'll be a lot happier. Okay. Also, what's not high equity note deals? As I said before, you have some people that chase high equity. Oh, that the house is way worth a whole lot more. You're not going to end up with that asset most of the times. Either sell at the auction or the borrower is going to file bankruptcy and drag it out. Okay, so don't get sucked into that. Now, where is the most inventory we're seeing these days? Of course, we still see a lot in Ohio, Michigan, Indiana. All three of those states are three of my favorite states. Illinois, you see some stuff. I will buy outside of Cook County. Missouri, I've seen more distressed stuff in the bigger markets, St. Louis, Kansas City. Florida, oh my God, Florida is back on the market with a lot of distressed inventory. You just got to be careful what you buy down there. Insurance cost, condo associations, it does not come without its hurdles a little bit. And then we're also seeing a lot more in reverse mortgages where the borrower has passed away. More people are getting older. Obviously, people are getting older, they pass away, but we've seen an increase in reverse mortgages over the year. And we've been buying more vacant reverse mortgages where the only goal with that is to basically you buy it at a discount and foreclose and either A, make money at the foreclosure auction by selling it there, or you take the asset back and then sell it off. Okay. And then we do see a lot of opportunity in small balance commercial real estate. Small balance, sub 5 million, under 2 million. A lot of your banks finance the commercial boom these days in this round versus back, it was all Wall Street back in 2008, 9, and 10. So if you're in an area and you're knowledgeable of that area and you can buy a small balance commercial real estate, small strip mall or something like that, there's opportunity. Small apartment complexes under 100 units, there's that opportunity to buy some of that stuff at a discount. Okay. The pricing models, people always ask me, what are things going for these days? And it varies across the board. Okay. Everything always asks me, what's non-performing notes going for these days, especially when you have negative equity. By negative equity, that's where the borrower's upside down. We'll talk about the stair-step model on the next slide. So just keep that in mind. Negative equity, that means they owe more than the property's worth. Okay, so as an investor, your valuation is not on what's owed, but it's actually on the property value. Now, we'll get that in a second. Now, with performing notes or non-performing notes with equity, Yes, with equity, you're going to have to probably pay 80 to 95% of the unpaid balance or the payoff amount. All right. Sometimes it makes sense, sometimes it doesn't make sense. But if there is equity, you really need to be looking at 80 cents on the dollar. Okay. And by equity, we mean a sizable chunk, usually 20% or more. Okay. Contract for deeds, you know, non-performing contract for deeds, we would used to buy stuff at 30 cents on the dollar of the unpaid balance or the fair market value, whichever is less. Performing, you will still see stuff at 60 to 80% of the fair market value when they owe more. Okay. Now, if they owe less and there's equity, you may have to go up to 80 cents on the dollar, just like anything else, depending on the underlying asset value. Okay. Just keep that in mind. Junior liens, we just don't see great discounts on those. They're overpriced and there's just a current due to lack of inventory. Okay. Like I said, commercial is all going to vary by the cap rates, the asset class, and what's going on with it. So I'm not going to dive into that. But you're going to submit your bids usually as a percentage of the unpaid balance or a percentage of the legal balance. Okay, minus your taxes owed. If there's more than 1 year or more than the current year of taxes owed, deduct that from your bid and say, hey, I would have bid 65,000 on this, but there's 5 grand in back taxes owed for the last 2 years, so my bid's going to be 60 with the back taxes. And double check your taxes before submitting bids. Okay, you can go to the county records and check those all day long at Netra Online and other websites, so you know what's owed before you submit. Okay, now when it comes for the negative equity, the stair-step model, here's what we talk about. If you're down here at the bottom where it says below 30,000 fair market value, you shouldn't be bidding more than 25%. Okay, so they owe more than the property's worth. So it's the house is only worth 30, they owe 50. Well, I'm only going to offer 25% of the fair market value. And as you climb up that, so this same thing, 30 to 40, it's 35%. 40 to 50, it's 45. 50% plus, you probably have to beat 55% of the fair market value. You start getting above $60,000 in assets, 65% for a one-off is pretty common. It's not pennies on the dollar. It's not 5 cents on the dollar. You're going to be bidding, under what you would probably pay for an REO most cases. But understand, pricing has gotten a little bit more expensive than over this. And this is just a guide. It's not a hard, fast rule. It's a guide if the seller does not give you type of pricing. Okay. Keep that in mind. And of course, you'll adjust your bids based on what type of yield you're looking for. All right. If it's an occupied asset and the borrower's made a few payments last year, you may only want to bid at 62 cents on the dollar or 60 cents on the dollar to get your yield if they reinstate. It all varies. Okay. Now, people always ask me, well, Scott, why do you like occupied assets versus taking their property back via foreclosure? The reason you want occupied assets is it's usually in better shape. Somebody's living in the property and taking care of it. That's the first and foremost. Somebody's kept the power on. The HVAC hasn't turned around and walked off. It's in better condition. More exit strategies. You've got a whole slew of exit strategies that are available for you when it's an occupied asset versus a vacant asset. So more different ways to make money. It's easier to reinstate or work to modify, do a trial payment plan for the borrower. It's easier to do a deed in lieu or cash for keys if it's occupied. And the emotional equity a lot of times can help you keep borrowers in the property versus them moving out and not taking care of the property, moving somewhere else. I like to keep people in their houses, and we're able to do about 65, 70% of the time. Okay. And the number one thing, it's less capital expenditures like the HVAC, the roof, the wiring, the plumbing. Somebody's living inside the property most of the time. It's to be taken care of. We have seen some assets where, they're not taking care of the property, and I wouldn't buy that. Never buy a note you don't want to end up owning. I didn't say live in, but owning. Okay, I've bought plenty of smaller assets that I wouldn't live in myself, but are good little quality assets for somebody else to live in. All right, smaller assets or in areas that I wouldn't live myself, but other people are living there, and that's okay. Right? Now let's dive into the different funding options for you as we get rocking and rolling here, okay? First part's all about the finding side. This next session is all about the funding options to you. How do you fund a note deal, right? Well, how do I pay for a note? Well, you're going to use a variety of usually cash wires. When you pay for a note, it's not going to a title company and closing on a loan. You're going to wire cash from your IRA or your checking account into the lender. Okay. Sometimes you'll wire into an attorney's account, and that's fine. You can use personal and business lines of credit if you want to use that to pull money off of. That's fine if you've got those. We've also got a good friend, Merrill Chandler, with getfundable.com, who helps people do that. All right. We just did an episode with Merrill recently, and I'll show you what the link to that is in just a second. But he helps all of our students out getting lines. If you have a new LLC that's less than 2 years old, you're not going to get a line of credit. Okay. You need a business that's been in for at least 2 years to get a business line of credit, and he'll show you how to do that. He's helped our students get six figures and stuff. So he's also got a boot camp, usually like a 2-day course he hosts from time to time, getfundablebootcamp.com. All right. But a lot of you, if you don't have your own money, you don't have lines of credit, you don't have retirement accounts, you're going to use OPM, other people's money, to fund your deal. Okay. You're not going to go and get a hard money loan to buy a note. They're just not going to do. Now, sometimes hard money lenders will sell notes, but they're not going to give you a line of credit to finance your non-performing note deal. They want to own the property, not the note. So if you have a self-directed IRA, great. That's a great point. Yes, you can use it to buy, whether it's a Roth or a traditional IRA, a solo 401k, a SEP IRA, a self-directed HSA, an educational IRA. You can also get a self-directed IRA LLC, which gives you fast access to it. Some of the IRA companies out there, like Inspira, have made it so damn difficult to fund on a note deal because they make it impossible because they just don't seem to understand it. Equity Trust is the biggest company out there, but they all have such high rollover as far as employees. So it can take what should take 7 days to fund, takes 2 weeks, 3 weeks sometimes. So getting a checkbook IRA LLC I think is really one of the smart things. If this is going to be something you're going to do on a regular basis, just because the speed of the transaction can be so much faster in days instead of taking weeks. Okay. And we have a preferred vendor, Safeguard Advisors. They actually create all these self-directed IRA checkbooks. They're with Solero Bank. All right. So it makes it very easy for you to have a debit card or checking account to fund your own transactions with your IRA, completely legal. You can book a phone call with our buddy Nick over there by going to our website, weclosenotes.com, and scrolling down and to see where you open your self-directed IRA LLC. And we did a podcast episode with Nick Sahagan, episode 1041. Golly. It's hard to believe it was 50 plus episodes ago. But anyway, reach out to him or shoot me a message or an email. I'm glad to make an introduction to Nick for you to help you get your IRA LLC together. Okay. Now, there are other ways to fund. You can do collateral assignments. If you've got existing performing notes, you could pledge the collateral, cross collateralize your collateral for a new note funding. You can pledge the collateral of the performing note. We've done that before. We were buying a note, and we had a funding company come in, would fund 85% of the note, but they wanted to hold the collateral file. So once we closed, the collateral file and all the assignment stuff was shipped to them. We couldn't foreclose without them, right? But it gave them collateral to hold that note in case we didn't follow through. Okay, all right. They'll file a UCC1 at the county against the LLC, which is fine. You can also do a co-assignment of interest on the assignment of mortgage, where your investor is also codenamed. So with every type of note, when you buy a note, there's an assignment of mortgage is what's filed at the county. That's what transfers ownership. Okay. And it'll show from ABC Bank to Inverse Asset Fund LLC. Well, if you're going to bring on an investor and they want their name to be somewhere, then you could say, okay, we're going to buy this note from ABC Bank, and it's going to be assigned to 50% interest to Scott Carson LLC and the other 50% interest to, John Holmes Invest LLC, whatever it might be. Okay. If you've got property, you could also have them take a loan out in a junior position against that property to protect their investment. Some people got talking about partials. Oh, I want to do partials. Well, partials are the most overblown strategy out there. Yes, can you do it with small amounts? Yes, you can do it. You can do it from performing notes, but you're not going to buy a partial from a bank. All right. And a lot of the owner finance people don't understand it partial either. They want to sell the whole thing, not the partial thing. So yes, you can do it with a small balance. You can only going to do it from an owner finance note position. You're somebody who's a private seller willing to do that. And one of the great, probably the best strategy for that would be Tom Henderson's strategy, a friend up at Dallas who does the whole thing. I'll give you 10 months for 12 months. If you're going to give 10 months for 12 months of payments, you're going to make a 20% cash and cash return. Pretty simple, pretty easy to do. We're not going to go into that facet. Like I said, partials are the biggest overblown aspect of the note world. Or you can, if somebody's going to bring a chunk to the table, $250,000 or greater, $500,000 or greater, start a new LLC with that investor and go from that route. Right? And or your investor will fund an LLC that you own. Could be something that you're selling off shares of your LLC. Of course, you can go create a fund. You can do a 506B or 506C, all that stuff you want to. look, the easiest way is just to keep one investor funding one deal. All right. Don't bring in two or three investors to fund one deal. That's pooling money that's illegal, unless those three investors fund an LLC together and you borrow from the LLC. Don't go pooling money. Don't go talking about, I'm going to go put a fund together if you've never raised 50 grand. Okay. 50 grand is really like the starting point. And like like I said earlier, will a bank give me a note loan? No, banks will not lend on notes. Okay. Now, smaller banks may do collateral assignments. I've got a couple friends that are hard money lenders in Houston who have a bank that will give them a collateral assignment of 50% of the balance on their notes. Okay. So if they do a loan for 100 grand, they'll do a collateral assignment to the bank, and the bank will give them another $50,000 to go out and lend on. Okay. Some banks, some of your commercial banks, will do joint ventures or reassign the note where they will finance the purchase of that non-performing note, usually on $1 million portfolio or $1 million asset or greater. They'll give you up to 80% and carry the financing, and you just got to bring 10, 20% down. Okay. Novice Bank will do this on their loan sale agreement if you're looking to partner. Like I said, it's usually got to be $1 million plus loans. We've had people do it on a portfolio of residential loans before they bought from a bank. But usually they're going to want to see team and experience of that, or having, and your team can be your attorneys. It can be your servicing company. It can be your experience. Okay. Just understand it. You're usually going to have to raise capital to go do that. And like I say, it may require a percentage of the down payment, 5, 10, 20%. 20% is about normal we see when a bank is going to carry financing in some sort of fashion. Okay. What about hard money lenders? Hard money lenders will not lend on notes, as I mentioned before. They want to own on the deed. They like short-term loan deals, 6 to 12 months. Remember, they're making points and spread between what they're borrowing their own money at 8% and lending at 12 to 14. They don't want to be into a 20-year note for 5 years. Okay. Like I said, they like to control the asset and can foreclose with deed of trust state. They want to make their money on the points and the churn if they can flip that money every 6 months and make another 2 to 3 points, that's what they're making. Now, they may have notes for sale, but most hard money lenders I find will not sell at a discount. They want to sell it at par. All right. And I'm not going to waste my time at par. Now, some of these notes will be at 12%. If great, if par, if you want to make 12% on 6 to 12 months, by all means, go buy those. All right. Go buy them. I don't have a problem with that at all, but they're just going to be shorter term loans and rinse and churn and burn. You're not going to make the points, but you can make the 12% in a lot of cases. They may still want to retain servicing on that as they're doing the workouts or managing the project. And I would highly encourage that, but make sure you get to know the hard money lender, make sure they're not in trouble. Okay. Now, when you're funding on a note, do we just fund the purchase, or do we add other things to the funding amount? And yes, you want to add other things to the things. If it's got a couple of years of property taxes, yes, put at least the last couple of years of property taxes on there as well. You're going to review your values and from a BPO, broker price opinion, or a qualified realtor's comparative market analysis. And so you may want to throw on there as well. Always put eyes on an asset before closing on the deal. It doesn't have to be you flying out to take a look at it, but make sure you send a realtor or somebody you trust to drive by the asset and confirm what condition the asset is in. Now, you're not going to get interior access unless it's listed for sale or short sale, stuff like that. But most of the time, especially if it's occupied, you're not getting interior access. You can tell a lot about exterior condition. Does it have toys in the front yard? Is there some pride of ownership? All that stuff. Okay. You want to budget in your foreclosure, taxes, workout, servicing costs. So one of the things that we do is we'll say, okay, if it's a non-judicial state, we'll add 2,500 to 4,000 in that extra funding amount, so we don't have to go back to the investor. If we don't use it, great. We end up paying it back anyway, and it's tax-free money for us. If it is going to need some workout, some repair costs, clean out, paint and carpet, understand what that is. Talk to a crew. Talk to CertaPro painters is who we use. Hey, what do you charge roughly for an 1,800 square foot house? Give me a ballpark. Okay. What's a roof going to cost me in there things? Okay. You're going to add forced place insurance in case the insurance is not being paid. And that can cost you quite a bit in Florida or other Gulf states. So make sure you understand what insurance costs are. There may often be utility, HOA, code enforcement liens that don't go away. So that's going to be something that comes out of after the deal. Some of those liens get wiped out in some states, others don't. Some others follow. So keep that in mind. Okay. And you may want to add $500 to $1,000 in marketing costs or an asset management fee. because it does cost to be a note investor with due diligence paid on properties that you don't end up closing on, or your CRM or other website stuff. So add a little bit extra over time. That extra comes in handy when you're buying multiple assets where maybe you under figured out, it's you got a foreclosure dragging on longer than expected in some states. Okay. Um, but the cardinal rule we like to put is staying below 65% of as is fair market value when funding. We don't want to go above 70% usually. We want to say the 60, especially non-performing. Performing, okay, we'll go a little bit higher because it's performing. But when it comes to the non-performing side, which is what we focus on most of the time, that's where we want to stay at below that 70%, especially 65%. Okay. There are 5 things that are going to be protecting your investment or your investor's investment. And that's things to keep in mind. First and foremost, that we're buying only first liens. We're in the most secure position besides taxes. Taxes can wipe it out, but we're going to pay the taxes. All right. We're going to be buying below 70% of as is value. We're going to be using servicing companies and attorneys to collect and foreclose. They're going to do all the heavy lifting. It's not me having to go knock on door and collect. 4, we're going to put property insurance. Forced place insurance is what FPI stands for, either through a servicer or our own. In case of an act of God or something happens, disgruntled borrower, that's fine. Go pour concrete down the drain. It doesn't happen very often, but guess what? If you do, I'm going to get paid an insurance claim. And 5, we're going to check title and collateral files to make sure we have all the T's crossed and the I's dotted, so we have the right to foreclose and all the clean paperwork available needed to it. Okay. Now, we did a podcast episode with our buddy Merrill Chandler. It was episode 1088 on the different lines of credit that he creates and stuff like that. Or not he creates, but he's able to get for clients. So check it out, episode 1088 on the Note Closure Show podcast. Okay. And he's as we say, our credit Neo, our credit Morpheus. He's a big fan of the Matrix movies. So he'll help you take the red pill to see the true world of financing and bank financing, all that stuff's going on with FICO and your credit scores. And it's just not all about your credit scores, everybody. Okay. But he will show you how to secure 6 figures in lines of credit for your business. Okay. Session 7. Let's talk about how you find investors as we kind of hit the halfway point here, just beyond it. One of my favorite parts of this is when I talk about this, people's eyes just light up. That light bulb goes off in their brain on how to find investors, because this is always one of the biggest questions. How do you find notes? And then how do you find investors? Okay. Now, finding investors to fund your deals. How do you do that? Well, first thing that most places people go to is like real estate investment clubs, meetup groups. That's a great spot to go, but it's full of sharks. It's full of real estate investors who may have money, but they want to make 12, 13, 15% of those. They may not actually want to make a 6 to 8% return. But you know what? It's still good to go join. One of the most important things to do is go network with other investors. Okay, LinkedIn. Yes, you can find investors on LinkedIn. Type in private investors or SDIRA investors on there. Different keywords. There's different LinkedIn groups, profiles if you search on there. People, I found private capital on LinkedIn quite a bit. You can go to Connected Investor, that website, privateinvestor.com. You can go to Bigger Pockets and look for investors on there. Keywords, do a keyword search on there and then send them a short 10-minute pitch deck video to help them find an opportunity with you. And so many people will go on these different websites, say, hey, I got 50K to invest or I got 100K to invest. Use those as your keywords and you'll be surprised. Okay. You can also go to self-directed trustee events. Like there's a lot of these companies that have educational, their own meetup groups. A lot of it's online, but some of it's in person. That's a good thing to go to. I prefer to find investors who have pulled the trigger before via the public records. And this has been the gold mine of us creating a river of private capital, not only for ourselves, but our students out there who are doing the same thing. Okay. Now, we use a website called netraonline.com. This is a free website that kind of brings all the states, all the county records, all the recorders, the GSI mapping, all those websites together in one spot. If you go to Netra Online, you'll see a map. You click on the state, you pick the county, and you'll see a listing of every county in the country of how to tap into the county clerk or the county appraisal websites. Okay. And we love it. It's free. We jump on the appraisal districts. Okay. And we do a search also at the county clerk or recorders. But if you do the county appraisal districts, you'll see everybody with a quick search of who has used their self-directed IRA to buy a piece of property by just searching for like equity trust, as the owner's name. Now, some states don't allow you to search by owner's name, so it's a little difficult. You got to go to the county clerk or recorders. Same thing. If you go to the county clerk or recorders and search for the last 2 years, say equity trust. as a deed search. You'll see everybody who's lent money out of their IRA to potential investors. Okay. This is worth its weight in gold. And some of these counties will literally allow you to do a download dump where it's in a literally a spreadsheet you can do a mail merge from. And then you send a letter postcard out to these investors. That's what we've been done for years. Okay. So, one of the great things that we do with our class is show you exactly step by step how to do this. Okay. Appraisal Disc is very easy. Just search the different names of the IRA companies, property owner. We used to search Equity Trust, Quest Trust. It's now Inspira. Those are the two biggest ones here in Texas. And so we search this and we'll find hundreds of IRA investors. We'll also find their mailing address. And we can send, if they've got their name on there, the account holder's name, great. If it does have that, we can search to see if they own other real estate in the area. If they don't own other real estate, we'll just mail a postcard or letter campaign. But if we do get their names, we'll skip trace them. We contact them on social media. We'll find any other properties they have and reach out to them directly, and be able to save money instead of mailing out postcard and stamps and letters. We can do it digitally through our CRM. Okay. We can also, like I said, we got a skip tracing company that we leverage when we download a list of the stuff that we'll skip trace through them to find all sorts of stuff, and then search on Google white pages for more information. Okay. If can't find a name, can't find an email or another address, we'll mail the postcard to the mail address based on the county records. And it's usually a multiple touch approach. It's a letter one time, it's a postcard second time, another letter. And the whole idea is just to get them to reach out to us. And we'll send them to our pitch deck video of 10 minutes. We'll send a couple case studies. It's all about that 80% of sales comes after the fifth contact. Now, the county clerk is important. If you're in a state like Minnesota, California, Maryland, Virginia, that don't allow you to search at the appraisal districts by name, you'll do a deed search at the county recorder's office or the county clerk. Same thing. You're going to type in the name of the IRA company. It's going to give you a list of people on the deed search or release of lien. That's awesome. Hopefully it gives you the mailing address on there for the release stuff. That's valuable. And then you go skip trace that. The great thing about this, the clerk, though, is it's going to show you how much money the borrower actually lent on it. And so that gives you, say, hey, somebody just got 50 grand back or 100 grand back. And it's the same thing. Mail a letter, postcard, and contact on social media, and rinse and repeat it. Okay. And we did episode 1030 of our podcast recently. How do you find private investors in your county? So I encourage you to go check that out on the Note Closer Show podcast, wherever you listen to podcasts. It's also on our YouTube channel where we break it down and kind of go through it as well, too, on weclosenotes.tv. Right. Now, you can also, if you don't want to do the whole on a pool list or hire a VA, you can purchase custom lists of IRA owners, not specific to a true self-directed IRA custodian like Equity Trust or anything. It's going to be any type of IRA company or bank. You can actually buy a list where they've got the list provider can guarantee that they've got 150K or more, and you can narrow it down by cities or counties and stuff like that, states. You can also purchase a list of employees with a company. There's some employees with companies that are making good money. Halliburton, Boeing, some of those things. Okay. This list will include names, addresses, emails, phone numbers. It's a really kind of cool thing to do. Melissa data, exact data, especially if you're buying in a state or investing in a state that doesn't give you that free search. You're going to have to pay about $1,000 for a list. It's going to be 6 to 14 cents a lead. If it's a business list, it's going to be 25 cents per lead. But that's a lot of people on the residential side, 16,000 names and emails. So it's going to be difficult for you to implement that if you don't have marketing in place. So yes, a letter campaign, an email campaign is great. Even uploading that list to social media, see who has a social media profile, and then market that list. Or some things you can do out there. Now, where can you post? You should be also, this is an important thing, besides just targeting people on social media, stuff like that, you should also be posting about your deals. Okay? Don't post, we'll buy your note. No, that's a big joke. Okay? Post deals from past experience. If you've bought a note, talk about what you paid for the note. Post deals from others, case studies. It's one of the things that we share in our 2-day workshop, is different case studies. We give our coaching students different case studies to post. Post deals that you're working on. Post past deals, all right? But you never want to mention safe or guaranteed in your postings about the deals. Talk about, hey, we made this type of percentage, or our private investors making 10% on this deal. Those are great words to say. We talk a lot about posting and creating a short pitch deck video. That's very important to do in today's world. It's because it's your advertising. It's a commercial about what you're doing and what people can learn more about you. Okay, and your pitch decks can include about you, your focus, your company, your vendors, and the types of deals that you're looking to do or past deals. Okay, qualifying investors. Not everybody's going to be a good investor. The thing I always like to ask: are they currently investing in real estate, or have they invested in real estate in the bags? Are they accredited or sophisticated? Okay, how much are they looking to put to work? Okay, how much are they looking to invest? That's important. That's the number one question you got to have answered at your first phone call. Not the first question you ask. But you got to know moving forward, is somebody going to have 50 grand to put to work or just 5 grand? Okay. How long? Are they comfortable tying their deal up for 2 to 3 years? Not 30 years, but 2 to 3 years. That's still short term. And are they looking for an active return or a passive return? If they want 15%, that's active. Let them go do it themselves. 8 to 12, we can usually give that on a passive, depending on a case by case study. Okay. And I think, what kind of returns are they looking for? Same thing. Like I said, sometimes it wants 20%. That's too expensive. I can't do that. I'm not going to give you deals on that are like 30%. I'm going to do those deals myself. All right. But if you want to make money on passive basis, I can give you 8 to 12%, especially if you're not making anything in your money the last 12 months. Okay. And we use an investor questionnaire. It's required for our investors to fill it out. We go through that in our workshop and provide a sample copy of that for you. Okay. Now, there are investors that you want to avoid. People with unfamiliar to real estate that don't have a clue about what investing in real estate is. People that want short-term or higher ROIs, all tied up for 3 months. Well, I'm sorry, that's just too short a deal. I want 25% of my money. Well, okay, go do that yourself. I usually like to have folks invest at least 50 grand or more when you're starting off. You're going to have friends and families. Okay, 25 grand, but understand, don't take their last 5, 10, 15 grand because they're going to be a big pain in the ass. And look, you're interviewing these folks just as much as they're talking with you. If you see them talking bad about politics or bad about other investors or other deals, avoid them. Okay. One of the questions I always ask: are you involved in any type of suit? If somebody's sue happy, avoid them. You want to try to. There's things that's going to happen along the way. You want to try to be as cordial and work things out, especially like through arbitration or stuff like that in your agreements. But always ask for references: past partner, CPA, attorney, banker. You ask for references just as much as they ask for references as well. Okay. Always require your investors to fill out your investment profile or questionnaire. Don't post it online. Oh, hey, go to my website and fill that. No. They're not going to fill that out. Okay. Send your pledge letter or an email saying, hey, here's my proof of funds with 100 grand put towards note deals with you. If they won't return these three items, they're not going to fund. And you need these in case they do flake, that you can show your seller, hey, I did have money raised and this investor flaked on me, because it will happen. Okay. Now, if they're going to be pulling their money from Chase or equity, from a non-equity trust client or something like that, you need to have them open an account with somebody so they can transfer that 401k or that IRA over into a true self-directed custodian so that they can invest it in notes in real estate. Okay. And it's going to take at least 3 business days for them to sell out of it. If it's in a fund or if it's in a stock, it's going to take at least 3 days to sell out of that into cash before they can wire it to the new account. So keep that in mind. You're going to need that week to get it set up and the transfer to take place at a minimum. Okay. Now, this is important. Always have your paperwork and agreements created by an attorney. All right. Always allow the CPA or attorney's review. I don't have a problem them reviewing it. I just want to make one thing. Have they bought debts before? Have they invested in real estate? If they haven't done those things and they get it sounds so risky, I'm going to kibosh it right off the bat. Like, well, would you go to your brain surgeon for dental advice? No, you wouldn't. Okay. Always use agreements that outlines when things go wrong, especially with family and friends. Most investors aren't going out and making above 6%. Okay. That's why you ask them what they have invested in. If they're in like CDs, stocks, bonds, making 5, 6%, okay, good for you. I can give you double that. Would that be interesting? Okay. If their money is making 0, sitting in an account, not doing anything, 6% is an above average return for them. And that's what we offer, above average returns. I don't go and say, we'll offer you 12% right off the bat. Why? When they couldn't make that themselves. Okay. Now, somebody's an active investor, 12% pretty desirable. But I always like to see where's the money coming from and where it's been sitting at. If it's been sitting vacant for 2 years, 3 years, I'll give you 8%, okay, or less. You're going to want to make sure that there's people are paid on a regular basis and communication. How do you make payments on a non-performing note? Well, I don't make payments to my investors on non-performing notes unless the borrower starts paying. Okay, when they start paying, then it's not a monthly payment; it's a quarterly payment or annual payment. I don't do monthly. Okay. Most people using self-directed IRA money, unless they're retirement age, they don't need that money. They're not living off it. So, and all that money's got to go back direct in the IRA account. So quarterly is great, or once we foreclose. Okay. You can set up an online portal for tracking help. You can use Podio, Pipedrive. I'm very simple using Basecamp. Some people use Dropbox, whatever, Slack. There's a whole variety of different things you can use. Google Sheets for tracking, but never, ever, ever pool money together. One investor per asset. One of the most important things you can do. Okay. And trust your instincts. If you've got a bad feeling about somebody, don't do the deal. Move on. Your gut will protect you in cases like that. All right. Let's dive into some of the different marketing tactics when it comes to marketing for notes. Okay. This is one of my favorite places to be because there's so many things you can do with the marketing side that we teach that others don't. And that's the one thing about taking our 3-day or 2-day class, a 3-day in person or 2-day online class, is you walk out a better marketer. Not many people are teaching the marketing strategies in 2026. Their ways of marketing are from like 1996, which is 30 years old. Okay. So once again, you have to realize 80% of sales are made after the 5th contact. And part of what we teach is the whole multi-touch, multi-post approach to things. You have to expect to post regularly and often, automate it with like buffer.com. It's a great resource for automating posts, news articles, case studies, images. You can automate it and reschedule this stuff or pre-schedule stuff out so you don't have to do it all at the same time. The 3 most important things to use in today's market when it comes to marketing is email CRM, and we use Blackbook REI. Damon Ramey's company is our preferred vendor for that. LinkedIn, you can use Octopus CRM to help with the outreach for that, or Buffer to post there regularly. And video marketing, YouTube and short video across not only just YouTube, but also across all your social medias. Okay. Email marketing, like I say, it's the number one ROI. Still to this day, you're going to make a $44 for every dollar you spend. Okay. And with email, when you send an email blast out, you're going to see a 17 to 20% open rate. Understand that. That's the first time out. That's a pretty good open rate. You're going to have to follow up, but that's the whole point of using a CRM like REI Blackbook, is that you can do it and pre-schedule it, okay? And schedule, like I said, if it's going out to your warm market list, send it out on a Tuesday, Wednesday, Thursday. If it's going out to your asset manager list, you can pre-schedule things out. You should send an email out to your warm contact list, people you've met at conferences, your networking events, your meetup groups, your friends, family, once a week. I like Sunday night, all right? Sunday night, 7 p.m. is when we usually like to send an email out, at least to our warm database about what's going on that week. All right. Who do I talk about? This is the thing that people always ask. Well, Scott, I can't come up with an email once a week. Oh, yes, you can. You can talk about every month has a holiday. Happy Easter. All right. Happy April Fools. Happy St. Patrick's Day. Happy Valentine's Day. Happy New Year's, right? Happy Merry Christmas. Happy Thanksgiving. Happy Halloween. I mean, you go back and forth on every month has a holiday. So that's one email. So, hey, happy Easter, happy Christmas, whatever it might be. Okay. If you have a local group or you're more local, talk about going to your BNI networking thing or your local RIA club meeting, what they're going to talk about tonight. Talk about a personal event. Talk about how you got back from vacation or you came back from a conference. Okay, don't tell them, hey, we're going to a conference next week. We're going to be out of the house for the next 2 weeks, so rob our house. No, talk about it afterwards. Or share a family event, like your kid graduating from college or high school, or celebrating your 30 years as a performing note. I mean, 30 years as a married couple, whatever it might be. Okay, but then also talk about past and present deals. The reason most investors fail to raise capital for deals is they're not marketing the deal, and part of sending this email out once a week is to get your audience to start paying attention to what you're doing. And Gary Vaynerchuk, who's probably the best social media mind out there, wrote a book a few years back called Jab, 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 Right Hook. The whole idea is the jab is you're adding value, content to your network, and then that right hook at the end is when you need somebody to fund. Unfortunately, most investors, when they don't do this ahead of time, so when they get around to needing funding, they're like behind the 8 ball. And they send out a panic email like, oh, email marketing doesn't work. Yeah, it doesn't work because you didn't put it to work. Okay. And like I said, your email asset managers is all about drip marketing once to twice a month to that list to get people sent up to you. Okay. And Oh, I think I already posted. Maybe I did already post this one, but we talked about how to find private investors or anything like this in our county in episode 1030 for you to take a look at. Pretty cool thing about the marketing process that we do in the follow-up side of things. Okay. Now, LinkedIn, very, very easy to use, but you need to have a complete profile. And yes, maybe having a paid version of LinkedIn is going to be worth it for you if you're going to use it. But the things you all should do is get you a free version of LinkedIn. If you don't have a profile on there, guess what? You really don't exist in the note business. Okay. Bankers are going to go to LinkedIn to see you. They're going to track you. They're going to look at your profile. Do you match up? Does your profile make sense? I call it the social media business resume. If you don't have a website, you better have a LinkedIn. Or yeah, you need to have a website these days, but LinkedIn is the first starting point. And making sure you have a good smiling photo, an image of your of your image of your logo or your company name, and then have your profile filled out all the way. Your about you, your featured stuff. It's easy to find investors and bankers on LinkedIn. Check out Octopus CRM to help maximize connections. We grew our LinkedIn from 6,000 to 30,000 connections over years of using Octopus 5 days a week. Very, very affordable. One of the most powerful tools you can use to grow. Only 3% of LinkedIn users post daily. So think about that. If you can post something, an article, a newsletter, you create your own newsletter or case studies, people will pay attention to you and they'll start to follow you. And you can join and post to the different groups out there as well. It's a great way to connect with other people that are more than like a third-degree connection away by finding groups that they're in and connecting with them. And yes, you can import a list of up to 1,000 emails into LinkedIn, and LinkedIn will go out and find if there's a profile that matches up with that email, and it helps you can kind of prime the proverbial LinkedIn pump to help you start connecting with people. Video marketing is just so important these days, ladies and gentlemen. So much more valuable these days than whatever it was. And you have a phone. If you have a smartphone, guess what? You can use video pretty easily. YouTube, that's the second number 2 search engine owned by the number 1 search engine. Okay. TubeBuddy is something that we use to help us grow with keywords. When you post a video, it's besides more than just a video. It's the title, it's the description. We use TubeBuddy to help us come up with that stuff. You can also use different AI tools for that. But you gotta, if you're not gonna take the time to put a good title or description with it, don't publish it. Keep it private on YouTube until you're ready to publish it. But then make sure you have a description, your keywords and thumbnails. Those are the roadmaps for YouTube to send views to your video. Description, keywords, and thumbnail. Okay. Now you can use like Facebook Live, Facebook Posts, TikTok. Most of those have a 24 to 48 hour lifespan, not 28 hours. But it's still good to post on those, especially case studies. LinkedIn Live, or uploading video, long form content, and short content on LinkedIn now works really well to share what's going on with short deals. Short case study videos of 5 minutes or less and have it rinse and repeat. But most of you guys are going to use your smartphone. Very easy to use with selfies to upload to TikTok or upload to Instagram or upload to Threads or Twitter or Facebook using your phone. There's so many great tools, especially TikTok. Record something, it downloads it to your photos, and you can upload that video to everywhere else. And we've used short videos to really expand our business a lot over the last few years. We use a thing called the marketing octagon or content octagon. If you take an image of a property you're walking or a property you're evaluating or a note you're evaluating, sharing that content and that short little video across multiple channels. Like I said, photos and stories do best. We'll use buffer.com from time to time to share across multiple platforms simultaneously, especially if I'm going to be out of town or my VA can log in a buffer and upload things, upload short videos and stuff like that that gets reposted again and again. Not everyone is on every platform. I get it. But you got to be on every platform these days, ladies and gentlemen. If you're going to be in this for the long term, leverage the free activity, the free audience that you're going to get by being on those things. You never know. You never know who's going to see your stuff. We've raised capital and closed deals on every platform: LinkedIn, Twitter, Facebook, TikTok, Threads. And for something that's free, use it. Okay. And the more you cross promote, the more hits you're going to see. And somebody sees your thing twice, guess what? Okay, they follow you twice. Whoopee freaking doodah. Now you've hit that 80% of sales made after the 5th contact now faster. Okay. Best time to post is at lunch, 3 p.m., 7 p.m., and 9 p.m. when people are death scrolling in bed at night. Okay. Start with one new platform if you're starting off with, and one new thing each week, and rinse and repeat. Get better at it. Get better at it. It's the only way you're going to do it. We use Restream to repost our longer form videos on a regular basis across all the platforms at once. And we also use Opus Clip to take our longer videos, chop it up into short videos, and post those short videos across every major platform. And it helps us a ton and very, very affordable. Okay. Let's talk about business structures because people are like, oh, well, can I use this? Can I use that? You've talked about funding. You've talked about marketing and raising capital. Let's talk a little about the nitty gritty, the black and white side of note investing. Yes, you've got to have a business entity. And let's talk about how do you structure your note business. You need to use entities, LLCs. You can use trusts. You can use S corps. Easiest thing for you to do is just an LLC. Okay. Now, people talk about, well, I want to use an LLC in Wyoming or Delaware Statutory Trust or a Nevada LLC. Just use a Nevada LLC. It's going to help you out. Yes, you can create LLCs in your states. Totally agree with that. Okay. But your main operating one, you should probably have it as a Nevada LLC. And don't keep more than $1 million in asset values in a single entity. Okay. If you're going to use, if an individual investor is going to bring 250K to the table or more, create a separate LLC for their deals. All right. Keep your deals and assets separate from your partner's deals, existing business. If you're doing something outside of real estate or outside of notes, have a separate LLC for your note stuff. If you're buying performing notes for yourself, keep those in a separate LLC from the ones that you're buying non-performing. If you end up taking some property back and you keep them as a rental, keep those separate from your note business. You're buying an individual commercial project, put that in its own LLC. If you're going to start creating educational and marketing stuff, keep that in a separate LLC. If you're going to do property management, keep that separate from your other stuff. All right. So yes, you will probably end up with multiple LLCs. It's called good asset management. Okay. Well, can I just use my self-directed IRA, my personal trust and create? Yeah, you can use that, but it's not going to necessarily give you asset protection. It's not smart to fund in your own name or your own IRA. Yes, people will fund playing those deals. But guess what? Do you want a disgruntled borrower coming back after you? Oh, here's your, I can track that person down and go knock on your door. It doesn't happen. But some people are scared about that. The reason we're using LLCs is the whole asset protection. The Consumer Finance Protection Bureau used to be around, would target people. You would get complaints and you don't want them targeting your IRA. Now it's the state licensing or the state consumer affairs division or what's the other big federal government thing that's tracking debt stuff. Anyway, the reason you keep it in an LLC, you don't want them to come file a complaint against you personally. It wants to go against your LLC. Okay. Now, some counties like Wayne County in Michigan and a few others, in poor counties, are actually suing the trustees for back taxes. I would not be surprised. You see this happen in like New York, Oregon, Washington State, where those communist states or communist governments, I hate to say this, they're losing investor money. So if they see that you've bought a property in your IRA, wouldn't be surprised if they start suing you for back taxes on that property. We've seen it happen before. Funding or joint venture partners, don't do some asset protection. Okay. We talked before about self-directed IRA LLCs and having checkbook access. Use NIC, use Safeguard, use Solero Bank to help you out that. Trusts are not recommended because, yes, you can create a trust really easy, stuff like that, pretty easy to. But if you're going to move it out, move it around, stuff like that, people are just going to want an LLC. All right, just keep it simple. You need to document things. Having an LLC is not just a trip to the Secretary of State and getting a tax ID number. You need to document your transactions, what you're buying from, if you're taking an apartment, who you're using, if you're reimbursed you for other things. So many different things that you have to document. Even if you're a single member LLC, you still need to document these things, okay? And it's important to use a company that can help you out with that. And we love using Laughlin Associates. They've been around for over 50 years of creating and keeping people's LLCs, their corporate veil stuff. Is so important for you. They help with asset protection and structuring the deals as well. They have an amazing corporate veil protection plan where somebody will reach out to you on a monthly basis and help you create the actual documents and disclosures and notices that you have to put in with your LLC and help you structure. So it's true an LLC, a true company, not just somebody out there doing things. Well worth it. So much cheaper than you would do it yourself or hire an attorney to do it. And they will also work with you to help structure trusts, wills, all this other stuff if you have a lot of other assets out there. They do a biannual event called Magnify Your Wealth Summit, magnifyyourwealth.com. They've done it on the West Coast. They've done it in Texas here. They've done it in Florida. If you want to attend it, it's well worth it. One of the most valuable 3-day events you can go to for asset protection. It's pretty inexpensive, like $3.99 to go to it. Lunch is included on that stuff too. Great networking, usually about 150 to 200 people. If you go to magnifyyourwealth.com and sign up for it, use the code NOTES, NOTES, and then unlock $100 off for you. They do that for all of our clients. And you can also go to lawfulnusa.com to find out more about what they're doing for asset protection. Well worth it. They work with 95% of our coaching students, and they just do an amazing job. All right. And we just recently had Aaron Young on our podcast episode 1086, where he talked about the asset protection for real estate investors and what you need to put in place in today's world, because a lot of people are suit happy. There's ne'er-do-wellers out there. So you got to be smart. Are you going to get sued at some point? Yeah. If you're a real estate investor in the real estate niche, you're going to get sued at some point. To just protect yourself, protect your assets, and go do that. All right. Let's talk about the different exit strategies available with notes, as we're kind of getting to the point where we're getting to the last few sessions here. You buy a note. How do you make money with that note? Well, there's basically 10 plus ways to skin a note, as we like to say. We did a longer form video on this, exit note strategies. You want to take a look at that at some point. But one, you can wholesale note, which is all about flipping contracts. So I get a lot of people like, I want to flip notes, and that's fine. But the work you're going to put into wholesaling, you might as well put into that raising capital to close more deals. But wholesaling notes can be done. We still do this from time to time. You can make a flat fee of like $500 or more. It's a low balance thing. You can make a 1 to 3 points based on the funding amount. If it's a performing note, usually 1% is pretty normal. If it's a non-performing note, 3% is kind of normal. You can do a double closing if you don't know the seller and don't want them to find out who or you do it for your buyer if you don't want them to find out who the seller is. Just do two contracts. Or you do a flat signed fee agreement before with somebody. We do that for all our WCN members. If they're going to buy a note, we're wholesaling it. We'll just turn them over and, okay, pay us our fee when you fund. You can also, if you're starting off or closing on multiple deals with multiple notes at one time, use a real estate attorney's escrow account to help the money to come in funding wise to come in, and then you wire out one wire. Okay. Especially it's good to do that, especially starting off with a new funding source. Good wholesalers know their deal and know how to market it. If it's a good deal, understand why it's a good deal. If you don't pay any attention to doing into a deal, you're just trying to flip shit, you're going to not be very successful and be disappointed. Okay. You can borrow. The next strategy is to try to get the borrower to start paying. You buy a non-performing note, servicing companies that reach out to the borrower. Okay. And they start reperforming and paying on time. That's what you ultimately want with buying notes. You bought it at a discount, borrower starts paying, you're making a double-digit return. You're going to need a third-party licensed servicing who's licensed to collect debt in that state. That's going to cost you $35 to $95 a month, $35 for performing, $95 for non-performing. They're going to handle the collection of payments, the borrower outreach, or as we call it, right party contact, and you're going to instruct the service. They work on your behalf of what you want to offer the borrower. All right. So when we buy a portfolio of notes or buy a note, we're going to notify the servicer, hey, we're doing this. This is what we want to try to work out. You know, hey, we know we're going to get a deed in lieu, cash or keys to the borrower, so they don't have to do a whole lot of work. Okay. So that's the thing. They work on your behalf. And usually what we're going to do is do a trial payment plan to start off with, or do a loan forbearance agreement, add what they're behind onto the back end of the note. We're never going to do a loan modification right off the bat. We're just going to try to get the borrower to start paying on time and do a trial payment plan for them. The reason you do a trial payment plan for the first 12 months is it's treated as a long-term capital gains at that point versus a short-term capital gains if you modify it. Okay. Modifications, hey, great to do. Like I talked about, we'll do a trial payment plan to begin with versus going to a loan modification, but it's basically about the same thing. It's a payment plan with a lump sum or extra payments. We always want to get the borrower to bring extra to the table. We're not going to usually just let them reinstate. If they do reinstate and they're behind by 2 years, we're going to return those payments and start the foreclosure process. They've got to bring a lump sum. All right, that's skin the game. For every non-performing borrower where we never got a lump sum on the front side of something, they always end up non-performing again and ended up going into foreclosure 90% of the time. All right, the TPP, as we call it, trial payment plan, will be 6 to 12 months. And you can do a variety of things during that trial payment plan. Adjust balance, forgive, reduce back payments, adjust the payment schedule, make it a bi-monthly payment versus once a month. Like I said, never go straight to a loan mod. Once you've modified the loan and forgiven balance, reduce interest rate, it resets the foreclosure clock. All right. It's not a new loan, but it's a modified loan. Now, if they stop making payments and don't follow through and you modify it, guess what? You can only go after them for what they're behind on now, not what you forgave. And if we're going to do a trial payment plan, yes, we're going to have the borrower fill that out, sign off on it. Loan modification needs to be signed. if we agree to something on the front end, we can just send the servicing company the bullet points and they'll create the paperwork and charge you for the paperwork and send it out. Sometimes you get a loan payoff where the borrower pays off the loan. That's always nice. You can do a reduced payoff and a settlement. We've done that before for borrowers where we're upside down. We've done it over 90 days. A payment plan paid off. Okay, you're going to pay a third, a third, a third. You're not. You have to realize if a borrower hasn't paid more than 2 payments in 12 months, they're not going to go get a loan. Especially if it's an owner-occupied asset, they're not going to go out and get a loan at all from a hard money loan to get refinanced out. Okay, if it's investment property or it's like a family member's property, then they could go get a hard money loan to buy it from the family member and pay you off. We've had people cash out their retirement accounts to pay us off. Hey, what do you have in your 401k? What do you have in your IRA account? All right, let's use that money to help pay off this off. It shouldn't be a penalty for paying off the house. Okay. You will handle the payoff and settlement with a servicer. You'll also need to do a release of lien from the county showing that they've paid it off. Okay. You can't allow a loan assumption. You've heard of subject to deals. Well, you being the lender, you can allow someone to assume the loan who's a family member, a friend, potential investor. I always want them to fill out a new 1003 application just to see. It's not a new loan, but we want them to get all of their information, social security number, debt to income, that kind of stuff, to make sure they can afford it. When you're doing a loan assumption or a modification, it's not a new loan. So you do not need to go get an RMLO or an NMLO to go and make sure it's Dodd-Frank compliant, okay? Most of the time, we're going to keep the existing payments, the unpaid balance, and the terms. We may have modified a little bit, but we're not going to allow them to drop it from a 12 to 6% interest rate unless they're bringing a huge amount to the table, okay? The borrower, your existing borrower, can quit claim the property to the new note payer, to the new sub-2 buyer, and the sub-2 buyers or the assumption buyer starts paying you, okay? You can do a short sale. If they're upside down, the borrower sells the property at an amount below the payoff, which is what the short is. The bank has to approve what's getting shorted here. I will approve a short sale as long as I'm making more than what I paid for the note most times. If it's not listed already, we do require them to list the property at 85% of fair market value in the MLS and not use a best friend to list it and drag things out. We're going to make sure that for somebody to come look at the property, they can do it at any time. It's not around the borrower's schedule. If they're not going to allow somebody to come see it, no, we're not going to do a short sale. We'll start the foreclosure. Okay, we'll reduce realtor's commission to 4% because if I'm going to bleed and take a loss, everybody's going to bleed. Okay, if there's no foot traffic, no showings in 2 weeks to 30 days, we're going to cancel the short sale and say let's do a deed in lieu, cash for keys, or consent to judgment, and let you get the borrowers out of the property. We're not going to sit there and drag this out for 2 months, 3 months, 6 years, whatever. Okay, and you can 1099 the borrower for the short to write it off. Okay, so that's something people don't. Tell them a 1099. I think it is, or whatever it is, they can file it. If they can't afford it, pay taxes on it, they can file an IRS form 928. I believe that's the form number to show that they're insolvent. If they can't do a short sale, then a deed in lieu or cash for keys or a friendly foreclosure, basically. We let the borrower walk scot-free. The borrower will deed the property back to the bank, back to us. When we either give them obviously they deed it back, we're going to give them forgiveness of debt. Some banks previously were trying to get the borrowers to sign off on a second lien or an unsecured lien. We don't do that. We're just going to forgive you. If you're going to deed it back to us, we're just going to forgive you the debt and let you walk. Cash for keys, $500 more to help expedite taking the property back. We've done up to $75,000 before for cash for keys. Normal is about $5,000 or less. Okay. If we're going to allow somebody to do a cash for keys, we're going to want the property in good condition. We want it clean, swept, vacant, obviously, and it helps them avoid a foreclosure on their credit. And we want to make sure there's no other liens on the property above yours. I don't care if there's municipal lien or small little liens, but we want to make sure there's not a second lien on the property, because if we accept the deed in lieu, it puts that second now into first lien position, and it's not a good thing. If there is a second, then we do what's called a consent to judgment or cash for consent. Okay. And you'll always want to pull title, see what's sitting out there, and get internal photos so you know what the condition of the property is. Okay. Because if you take a deed in lieu, cash for keys, you can't 1099 them for the difference above in most states. Most states are a one action thing where if you're foreclosing, that's one action. Some states are two action where if you foreclose and you don't get enough back what that was owed, you can send a 1099 to the borrower for the amount that wasn't paid off. Okay. You can sell the asset to another investor. If you've created value knowing which way the exit will go, if you bought a note, the idea that you're going to try to get the borrower back on track and the borrower's just been a pain in the ass and you don't want to deal with a foreclosure, like if it's in Cook County, sell it to another investor. Um, if it's in a, you bought it as part of a portfolio and you know the borrower is going to drag this out, just go ahead and sell it to somebody else, make a quick 5 or 10% profit. If you do that in 30 days, that's a pretty good annualized yield for you. Okay. Many funds, that's their whole goal, is to buy the notes in bulk, work to modify it in 90 days. If the borrower doesn't come to the table, start performing in 90 days, they sell it at 10% or greater of the purchase price. If you make 10% in 90 days, it's a 40% annualized return. Think about that. Okay. Sell to local investors, market via local meetup groups, real estate clubs, Facebook groups that you got to deal. Even if it's a handyman special, if the borrower, you find out the property's not in good condition, borrower sign it off, sell it off to somebody else. You don't have to do the rehab. Find you a investor-friendly realtor. If you need somebody, let me know. We've got a whole network of people that can do door knocking, property inspections, door locks, all those type of vendors for you. We can help out with that. Okay. Number 9, if a borrower's not going to play ball with you, can't pay, won't short sell, won't respond to you, you're just going to have to foreclose. Like I said, we talked about foreclosure costs. Non-judicial foreclosures are faster, cheaper, starting at about $1,000, $1,500 for the cost. Judicial foreclosures, you got to go through the process of foreclosing through the judges and the court system. That's going to be a minimum at least $2,500 or more. You're going to pay that as a retainer to the attorney. And sometimes you might get some retainers back if the borrower works, but other times you won't. You can either A, sell the property at the foreclosure auction and make money at the sale. You will give bidding instructions to the attorney foreclosing. And we'll often say, okay, give us up to 80 to 90% of the as-is value, the payoff. If you're owed more than the property's worth, if there's a ton of equity, you may want to make the opening bid your full legal balance if there's a lot of equity above and beyond what you're owed. Okay. We have one note right now. Borrower owes 200, the house is about 300. We bought it for 170. Our opening bid at the auction is going to be the full 200,000. If it sells, great. If it doesn't sell, we now own the asset and it's worth 300. It will sell it. If it sells at the auction, okay, we make 30 grand in 6 months. Okay. If it's not sold, you now own that property as an REO. Go change the locks, go evict the tenants, and go that route. Okay. But the foreclosure is basically going to clean title for the most part. Taxes are not going to get paid. Some municipal liens like water liens, weed liens aren't going to get wiped out. Those will have to be paid, but that's okay. Sometimes you can negotiate those down with the county. If you take back the property, make sure to place a lien on the property in the amount of what your investor lent you as a first lien, or over encumber the property with a second lien above what they invited so that you don't get these unscrupulous shysters who'll go slap a fraudulent lien against a property. You'll see that happen from time to time. Okay. And that's an asset protection we talk about doing in our 2-day class. Okay. Now, we talked about the whole goal of buying a non-performing note is to get the borrower back on track. Well, guess what? When they get back on track, it's called a re-performing note. You can turn around and sell that off. And yes, you can sell it. You can sell it after you've gotten 6 to 12 months of on-time payments. I prefer 12, especially if the borrower brought a chunk to the table. I'll look at 6 months. Okay. You want to make sure that note is with a third-party servicing company, so you're adding value, not self-servicing. You can only sell off of the P&I payment. If the borrower's making extra per month, you can't really throw that in there, especially if it's just for a limited time. Your basis is going to be the P&I payment times 12 divided by what type of return they're looking for, or a percentage of the value to see what it is. Okay. You're not going to sell it above the legal or above, if the value is above what's owed, you can't sell it for full value. You have some idiots out there trying to sell a note at the full value of the property when they're only owed like 200 grand. I'm like, that doesn't make any sense. You understand what you're bidding. Okay. Borrower may still be behind, but they've paid at least 6 to 12 months of on-time payments. Great. I'll consider that a performing note. I don't care if they're a year or two behind, but they've made 12 months on time and they're working towards that back bounce. That's really considered a performing note to me. Of course, there's bankruptcy loans. If the borrower files bankruptcy, that's a good thing in the note business. For you in the real estate business, if you're trying to deal with a distressed borrower and they file bankruptcy, guess what? You go on to some other deal. Well, for us, we love it because we've now got an attorney to talk to, and your servicing company will help you out with that. They'll usually often have a bankruptcy attorney to help collect on your behalf. I'll talk on your behalf. BK Chapter 13, that's going to turn into really a debt restructuring. You can actually pull the bankruptcy filing at pacer.gov and pull up the individual bankruptcy report, whether it's a 13 or a 7. But basically, a BK Chapter 13 is going to be a 5-year payment plan to pay off what they're behind on. So they still have to make their existing payment, but they're going to pay a little bit extra. You have the right to not approve the payment plan if it's failed or bad. And it's often BK Chapter 13s they're paying are often sought after by firms at 80 to 90% of what's owed. You can discharge the mortgage from payments if the plan fails and restart foreclosure. A BK Chapter 7, though, is going to be debt liquidation. The family does not get to keep the house. It becomes an REO because you're going to finish the foreclosure, or you can do a deed in lieu of foreclosure if the bar does not comply. All right. You can do a deed in lieu or foreclosure if the bar does not comply. Now, there are some other revenue sources with note investing that turns into deals on distressed notes. You can use these distressed note leads as potential subject to deals, lease options, wrap leads, distressed home sales or short sale leads for realtors if you've got a good realtor network. You can also target some of these for owner financing leads. Hey, don't lose your home. We can help you sell with the owner financing. This could also potentially be property management leads if it's a rental property or landlord or out-of-state venture, or it's a DSCR loan that could be an investor loan. Might be a potential property management lead. With performing notes, what we see often is if it's an owner finance notes with some seasoning, or it's an older owner finance notes, these could potentially be mortgage broker refinance leads. Hey, let's get you out of your 10% mortgage into something at 6 or 7%. You got all this equity you've been paying on time. Okay. Also could be potential property management leads as well if they're willing to sell or it's an investment property. Okay. Session 11 is all about if it's a deal or a dud. Things to consider before buying. There's a whole lot of things that you want to go through when you're doing the, when you're thinking about notes. What's going on with that deal? City issues. What's the values? What's the days on market? Does it look like it needs some things? We talked about size and population in the city. Where is it located? Are there colleges nearby? Okay. Does the asset meet your strategy? Does it make sense to do with performing notes or reperforming notes for cash flow to keep that borrower back into it? Are we going to get a decent amount of profit if we do have to do a deed in lieu or foreclosure sale? Are we going to be able to keep it in our portfolio if we want to do it, or doing, rental thing? Those three things are the most important things. Is it going to meet your strategy? You want to avoid weird ass assets or unfinished projects or just stuff that looks like crap. All right. We always want to try to make sure that the note has three profitable strategies. The first one being, if it's occupied, can it become a reperforming note? Will it make sense to do deed in lieu of cash for keys? Is it going to make money if I have to take it to foreclosure and it takes the full foreclosure time frame? I don't really care about rental or new note sale or origination. If I owner finance it, those will make money, but it's usually going to be a single digit return. I've got to make a double digit return for A, B, or C, especially if I'm using other people's money. You also want to think about, has legal started? You want to ask to speak to the attorney or see the attorney notes. You'll be able to see the servicing notes and should request it as part of your due diligence process, plus the whole collateral file. We talked about checking bankruptcy on Pacer, and look at the state's statute of limitations for debt collections. Every state's a little bit different on that. Okay. And then also, is the state have safe harbor like Florida, Colorado, Nevada, where you don't have to pay the full amount due to the condo associations or the HOA associations? Sometimes you get away with paying just a fraction of what's owed because of that. Safe harbor in Florida, if I'm buying a note and foreclosing and there's an HOA lien, I'm only going to pay either 12 months of the HOA fees or 1% of the original sales price of the property, and the HOA can't do shit about it. Okay. Due diligence is a longer process, and you worry about the borrower, the property, and the collateral file, ladies and gentlemen. We do a long due diligence video, especially in our workshops, about the servicing notes, the borrower's due diligence, how the responsible is. Have they filed out hardship letters? Look at the previous loan documents. We look at the BK. We do a little social sleuthing to see if they're currently there. What are they saying on social media? We also, if it's a vacant property, we'll look at neighbors and family members trying to find them out. And we'll also look at past and present employers based on the loan documents they provide. Obviously, the property is important. We'll look at values of as is in 30 days. We'll look at the exterior condition. We'll look at the market conditions. Is it in a good area or a rough area? Always put eyes on the asset before funding, making sure that property is there and not trashed out or gone or wiped away. Look at nearby sales and comps. And by nearby sales, we mean nearby sales, not something that's 5-10 miles away. Always order a broker price opinion. You can do that through us at weclosenotes.com, or get a realtor to pull a CMA if you know somebody that's local. Look at the taxes and pending tax sales, code enforcement liens, activity in the neighborhood, previous MLS listings, the rent rates, the HOA, condo association. Some places you can't rent, or you got to be age appropriate. And then look for any of these special assessments that may have been filed by the association. And then, of course, crime maps are always a good thing if it's in a city with one of those. Of course, you will not get interior access on most of these notes because if it's not listed for sale, you're going to base most of your stuff off of exterior conditions. Okay. Use Zillow up front, and then to make your offering, use Zillow, Trulia, whatever. And then once your bid's accepted, then you'll order a BPO and do a much more deeper dive into values. RPR uses a free AVM tool if you're a realtor. I also like to call the utility departments or the city departments to find out if it's occupied or utilities are on. And I can always, if I find that the value is below what was stated to me on the spreadsheet, I can always reduce or fade my bid with proof that the value is less. And the seller can either accept it or they can cancel it and I can move on. But always, always have somebody go look at the asset before bidding. Collateral files, this is what you're really buying, not the property. So it's the original loan documents, the mortgage, the chain of different assignments of mortgages that note's been sold a couple times. Look at allonges, such as the transfer. Check out the deed of trust and make sure that that matches up with the details of the borrower that you're buying. Look at any previous appraisals on there. That's great. They're outdated, but at least it gives you an idea what interior is supposed to look like. And look at the previous borrower's 1003, which is the application that most people are filling out from the mortgage company to buy that note. That'll tell you what they have: retirement accounts, other assets, all sorts of great stuff. And the soft versus hard does not mean a Viagra thing. Your soft collateral is going to be a PDF document, scanned copies that you're going to look at. And then after closing, usually within 30 to 45 days, you'll get the physical or hard copies sent to you from the seller. Your team of vendors is important. This is not a business you do alone. You're going to have vendors out there to help you. You have your servicing company. They're going to, like Covey Financials, who we use, coveyfin.com. There's Madison Management. There's Allied Servicing. There's FCI Lender Services, which is pretty horrible, but they're there. You also have Land Home. There's a whole lot of other servicing companies out there. Essence Servicing is kind of the expensive one. You can use a title company for O&E reports or a vendor. You can order O&E title reports from us at weclosenotes.com or use a company like Pro Title USA. You're also, one of the most important things is knowing the value of your company or value of your property. And you're going to want to order a broker price opinion from us. We can do that for you. You're going to want to hire foreclosure attorneys. You can either do the servicing company will have their own list. You can use legalleague100.com if they don't have somebody, or you can use like a referral from other investors. As far as collateral review, you want somebody to look at, make sure all the documents there. You can use like a company called CSC, which is out of Dallas. You could use another company called Richmond Monroe out of the Ozarks. We also provide collateral review. That's going to cost you about $150 per file. To give you a bit of an idea, of course, realtors are important to help you sell the asset. You can go to realtor.com. You can use nard.com to find realtors to help you sell the stuff. But when we order BPOs, we have a third-party vendor with nationwide realtors, so they're able to get a realtor to go out and pull accurate comps and take some photos for you, right? Property insurance is going to be something that's important to protect your investment. You can use Ross Diversified Insurance out of Orange County, the National REI Group out of Kansas City, or US Risk, which is located here in Texas, but they do stuff nation. All three of these companies do stuff across the country. Property preservation, especially in the winter, if you're buying something in the north, if it's vacant, you want somebody to go in and make sure the water's turned off and everything's winterized for you. And like I said, you can order your due diligence directly. We have an amazing group of vendors that we use for our students. Save you, instead of you trying to go out and do it yourself and pay a whole lot more, you can do it through weclosenotes.com or reach to me at scott@weclosenotes.com, and we can help you out there. Anywhere from door knocking to door locks to exterior, interior BPOs, all that good stuff. Okay. Now, what comes next for most of you? Well, I want to first of all say thank you for hanging around for about 2 hours with me here. But the next thing that most people do is they sign up for our virtual note investing workshop. It's a 2-day workshop. You can get signed up for it at notebuyingfordummies.com. Normally, it's about $9.97. We've reduced the price down in 2026 for you. We've got so many successful students have closed on 10 notes, 15 notes, 20 notes, 50 notes, and making above average returns. We could talk all day about what type of deals they're doing, but we are so proud of our successful students who are doing big things out there. All right. I mean, if you're wanting to make a double-digit return in your self-directed IRA, you could do like Sterling James did, bought a small note in Florida. We helped them find the deal, help them negotiate it, help them do the due diligence, and help them close on it. All right. What's included with our class? You get a 2-day live class that we do via Zoom. That's usually $9.97, but we do that live, so you can ask questions. You will also get the replays to the previous class that you just don't have to wait around to the next live class. You can actually start learning today. You also get a 200-plus page manual with forms, contracts, case studies. We'll also include our wholesaling and calling banks master classes as well for you. And this is good for you plus a partner or spouse. All right. So it's over 20. We also bring in a tape of list or two of notes that you can cherry pick from and make offers on. That's priceless. So you get well over $2,000 in value by signing up for our workshop. And we're here to help you. We always believe there's no dumb questions. It's just that no questions are asked sometimes. And that's the question that needs to be asked. And like I said, normally it's $997. We're doing it for the low price of $297 for you guys now. It's going to notebuyingfordummies.com. That's our Saturday and Sunday classes when we host it, usually from 8 to 6, 8 to 7 at night. We used to do it 3 days online and realized that people just couldn't make it on Fridays. So we've shrunk it down to make it more accessible for you guys during a normal weekend on Saturday and Sunday. And then, of course, guys, if you want to do more, but you want to spread it out, stay involved, then sign up for our WCN membership. It's $97 a month. Go to noteumbrella.com and get signed up for that there. Includes access to the replays. We do coaching calls on Mondays. We also upload our list of notes there that you guys can cherry pick. So $97 a month, it's the biggest bang for the buck and the all you can learn note buffet, like we say. So go to noteumbrella.com for that. And then, of course, we do have one-on-one coaching that we help hold your hand through the process. What's involved with a note coaching program? It's at least 8 weeks of one-on-one coaching calls. We do via Zoom. You get my list of 5,000 plus asset managers. You get my 12 hedge fund contacts. You get a year of the WCN membership. We'll help you with raising private capital. You get VIP access to me. After you do your 8 to 10 weeks of coaching calls, you come spend 2 days with me here one-on-one in Austin, Texas. And then we do a follow-up call via Zoom 6 months later. And we will help you find your first deal and help you raise capital to fund that deal. We are here to help save you money and make you money. If you're going to invest some time in the coaching program with me and money, we are going to work our ass off to help you make that money back. Because the cost, it's not the cheapest thing out there. It's right at 25 grand. But we do offer a discount if you pay in full. And we also have the availability to do a 24 to 36 month financing program for you, where we've got a third party vendor that will help with that, or we'll help you with that as well. So if you're wanting to finance your one-on-one, we do offer it through Ease Coaching. It's 2 years of W-2s. You got to make 40K per year, have a 620 FICO. And like I say, they'll spread the payments up over 2 to 3 years for you. So your monthly payments could be about $500 a month. There's no prepayment penalty plan for that. And that payment starts in 45 days. So you can get rocking and rolling. And most of our coaching students that go this route, we're going to find you a note that you can purchase that's going to pay you $500, $600 a month. So you can start paying, it starts paying your coaching program for you. So you may can even get into it with nothing out of your own pocket if you qualify. Okay. Like I said, we've got a whole, our normal total cost is already $25. If you do a 30-day paid in full discount, we'll drop $5,000 off it. So it sets up, and then we can set up, or we can set up a monthly payment plan. Bring a chunk down. We'll have it paid over 12 months. Or if you want to do the third-party financing, you can do that. It's a full year coaching, and like I said, we have a 95% success rate. The 5% success rate, 5% of those that aren't successful either disappeared or were not coachable people to fall through. We find deals for you by giving you our access. All right. And we've just went through this here. We're willing to help you get this rock and roll. If you're wanting to do something, let's talk about the coaching. But like I said, guys, we can find out in just a few minutes, in hours, not days, if you're proof of that, and get you rocking and rolling. If you'd like to dive in that, let me know. We're glad to send you the link to get this a short 10-minute application. But I think for most of you guys, it's going to be the next step is to sign up for our 2-day workshop at notebuyingfordummies.com. It's the biggest bang for the buck. We're going to show you, like I said, how to find, fund, flip, flow, due diligence, raising capital, how to find these deals. We're going to hold your hand through it for 2 solid days with yours truly. Now, are you going to learn everything about the note business in 2 days? No, you're not. But you're going to learn a whole lot more from me because I'm not going to blow smoke up your ass. No pitch, no pitch run to the back of the room or any credit card. It's 2 days of nuggets and knowledge with the note guy. All right. So, like I said, normally $997. Get signed up for this today at notebuyingfordummies.com. And like I said, guys and gals, we're here. Thank you for listening. And feel free, if you got questions, want to talk more about coaching or the class, book a call with me at talkwithscottcarson.com. That's a 30-minute call or Zoom with me. It's free. Talkwithscottcarson.com. And let's help you take your business to the next level, ladies and gentlemen. All right. Thank you so much. If you're going to hang around for the live version of this, we'll dive and tape it for watch the replay. Thank you for listening. Thank you for watching. Go out, take some action, and we hope forward to seeing you at the next virtual note buying workshop. Hey, real estate investors, thank you for listening to this episode of the podcast. If you would like to learn how to dive into the world of note investing, how to take your business to the next level, how to become a lien lord if you're a tired landlord, how to find real deals if you can't find any REOs, then you definitely want to check out our upcoming virtual note buying workshop. That's right. If you go to notebuyingfordummies.com, that's notebuyingfordummies.com, or click on the link below in the description of this podcast. You'll be able to register for our next 2-day class. It's just $297 for you plus a partner or spouse to join us live on Zoom on a Friday and Saturday. It also includes the replays of the previous workshop, the replays to that 2-day workshop, along with a manual with over 200 pages of contracts, forms, samples, all sorts of great stuff to help you find, fund, flip, and flow non-performing notes direct from banks and asset managers of all types on non-performing notes and performing and some re-performing stuff, or some other options for you guys and gals if you're wanting to become a note investor and learn how to dive into the world of the sexy side of real estate. I've been investing in notes for almost 20 years and will help thousands of people, and would love to help you on your journey to becoming a lien lord and actually making some real money without all the headaches and issues that come with fix and flipping, toilets, tents, and trash outs with problem tenants. We don't want that stuff. Let's show you how to make real cash flow without all the work on a semi-passive or fully passive basis, whether you're focused on performing notes or non-performance. We'll show you how to make above average returns with or without using your own funds. That's right. We'll show you how to raise all the capital as well. So make sure you get signed up for the next 2-day Note Buying for Dummies workshop. It's notebuyingfordummies.com. Get signed up for it. You won't regret it. And let's show you how to take your real estate and note investing to the next level. And this is Scott Carson. Go take some action, buddy, and we'll see you at the top.